Good evening, everyone. Welcome to the Board of Finance February 13th regular meeting of the Board of Finance. We are on Zoom tonight because of the snowstorm. We'll still do the pledge, so please join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic
for which it stands,
one nation, under God, indivisible, with liberty and justice for all. Just as a matter, we haven't done this Zoom Board of Finance meeting in a while, so just remind folks to go on mute until you want to talk. For those who may have noticed, we are missing two members. Art House was asked by the State Department to join a mission to Peru to give a talk at a conference on cybersecurity for the Andes nations. He is For those who might not know, Art is an internationally recognized expert on cybersecurity in the governmental sphere and served as Connecticut's chief cybersecurity risk officer under Governor Malloy. And Mike Doyle had his car break down. So we are down to 4 tonight, but that we do have a quorum and happy to have that. This is our first time with Town Manager Mark Nelson joining us. And so I wanted to give him a minute just to say hi, introduce himself. Mark?
Chair. Thanks, Lisa. Good evening, everybody. I think I've had the pleasure of meeting you at least once. I did get a chance to attend the tri-board meeting prior to my official start date, but so pleased to be with you and serving the residents and the great community of Simsbury. Just a little on my background. I previously worked for the city of Poughkeepsie as their finance commissioner and city administrator for 7 years before becoming mayor for the last year of then Mayor Rollison's term when he resigned to become a New York State Senator. Prior to that, I was Hartford's municipal tax collector for 8 years. And prior to that, I was a vice president at Bear Stearns, working in the municipal finance sector. So again, nice to be here and looking forward to working with you all. Thanks, Lisa.
You're welcome. We're very pleased to have you here as well. Thanks for coming. We're going to start with fiducians and Chris Kachmar and Tyler Polk. Why don't you start and go through your presentation? As folks have questions, can you pause periodically and give folks an opportunity to ask questions? That would be great. Chris?
Right. Well, thanks, Lisa, and good evening, everyone. Great to see folks. I know, as always, right, just a reminder, our slide deck can appear a little bit unwieldy on the surface, but as we've always done in the past, we'll keep you focused and on task with just highlighting pages here along the way to get you the kind of the salient stuff and keep everyone up to speed here. Bear with me. I'm just gonna scroll here a little bit. We'll catch up. We'll start with a quick catch up on the capital markets. So you'll see here on the page, in terms of broad themes, it was kind of an interesting year. As you all know, we got off a year or so ago to a bit of a slow start. A lot of that kind of premised on nervousness from investors, just in terms of the likely potential, at least as economists handicapped it, for a recession to kind of develop sometime in calendar year 2023. The ongoing geopolitical concern and the regional banking crisis last spring certainly didn't help things. We got off to a little bit of an uneven start. And then things began to stabilize through the middle of the year as the Fed began to message the idea. You may remember that we thought we were done with interest rate hikes. We might have to keep rates a little bit higher for longer. And markets kind of began to get okay with that type of an approach. And then at the very end of the year, Q4 in particular, an entirely different narrative where folks thought that the Fed now might be inclined to cut interest rates pretty early in 2024. We've since backed off that a little bit. But anyways, we never had a recession. And we actually, as you'll see in a minute, had a pretty good year in capital markets, both fixed income and equities, which of course is encouraging on the heels of the awful 2022. So there's a lot on the page on the screen here, admittedly. We talk a lot about, being mindful of slowdowns in an economic cycle, but kind of accepting their inevitability, right? So it's really difficult to try to time and reposition portfolios in advance of recessions because you just can't predict them with any type of accuracy or consistency. And as we've talked about a million times in our meetings, you're building resilient portfolios, building diversified portfolios, building portfolios that otherwise align with the strategic, the objectives actuarially and otherwise of your plans is the key to long-term success. So we'll show you those numbers momentarily. So we didn't have a recession. Inflation has in fact come down. The number today you probably read was not well received by markets, but heretofore, the Fed has made pretty good progress on the inflation front, and it's much, much lower than it was all not that long ago. So those are kind of the bigger picture dynamics I think that have garnered a lot of attention on the economic front. So while we didn't have a slowdown in 2023, right, we're not certain we're out of the woods just yet. And this is a busy page for sure that you have up on the screen before you. We won't go through each and every data point, but the takeaway is, right, that there are warning signs or things to be mindful of as 2024 takes hold. Maybe most notably in the upper right-hand corner of the page here, you see leading economic indicators rolling over pretty significantly and consistently over the last several months. And you see historically, when you get that type of weakness, generally it has been associated with an economic slowdown. Again, we haven't had that just yet. Things like unemployment levels, right, are a little bit above their moving average. That has historically been, a fulcrum point for a period of economic weakness. Some of the PMI indices in the lower right-hand corner of the page a bit weaker too. So the economy and the consumers continue to be pretty resilient. We haven't had a slowdown yet. We're not certain when we might have one. Remember, the Fed does have the cover, right, of having done their interest rate work to offer up those Fed cuts if they need to, if things start to get a little bit softer. So there is an exit if you will, into a bit more accommodative policy if they need it. Well, all right, let's skip to the chase here. So what happened in markets, most importantly? Upper left-hand corner of the page, you see the dark blue bars are the fixed income markets. You'll remember that the vertical bars are the full calendar year numbers for 2023. The encircled numbers are the fourth quarter alone. And it's kind of an interesting, you see with it, particularly in the fixed income markets, for a long part of last year, they were in negative territory from a return standpoint. As you'll remember, confronted by those higher interest rates and increasing interest rates. And again, November and December in particular, rates actually came down pretty dramatically. And a lot of the returns that were captured for the full calendar year were embedded in those last couple of months of the year. So you see the broad fixed income markets that your managers focus on. And we're up a little bit shy of, call it, 7% for the quarter and about 5.5% for the full calendar year. And that enthusiasm, I guess, pervaded the global equity markets as well. So you see in the center of the page there, the gray vertical bars, pretty healthy returns across global equities, again, punctuated by the U.S. large cap stocks in the square in the middle of the exhibit there, up 26.5%. And remembering, as you will, you'd probably read about now, right, the so-called Magnificent Seven. There's a handful of mega cap glamour tech stocks that were the lion's share of that gain last year, up on average as a cohort of 100%, if you can believe it, and pretty narrow advance. But one of the defenses, again, we have against that, as you all remember as well, is being diversified and not having too much exposure in any one area. And we'll again see that information momentarily. And then some of the diversifying assets there to the far right, the lighter blue lines there. REITs came back a good deal in the fourth quarter on the heels of those lower interest rates. And you can see some of the real asset complex as well had decent performance. Commodities were a noteworthy soft point. So kind of the reversal, right, of 2022 when commodities were the only thing that worked and everything else was negative, kind of the opposite outcome last year. Particularly energy prices were the primary input to those weaker outcomes. But a good year in markets for sure, and one again that'll help inform our update for you momentarily.
Chris, can you just pause for a minute?
Sure.
Are there questions from members at this point?
Anything on big picture stuff before we delve over into more
Just
interesting?
one big picture question. What was our rate of return? I know we assume it's going to be 6.5. Where did we?
Yeah, so for calendar year, the pension plans, Lisa, were up about 11%, each of them. The OPEB was up a little bit more. It has a slightly different allocation, you'll remember. So we'll show you some of that detail momentarily. And it was kind of an interesting, a little bit behind benchmark for the pension plans. Some of that was manager specific performance, maybe Barings most noteworthy. Remember the real estate manager? We talked about them at our fall meeting with the subcommittee and some of the things that they're navigating through. We do think they've probably reached a little bit of a floor there, and the real estate markets on the margin are starting to stabilize, I should say. Recover is too strong a word. But otherwise, and you know, a kind of good performance from across most of the managers, and a decent year. And we've had a decent run now, right? Because remember, 2019, 2020, 2021 were all good outperformance years for the pension plans. 2022, about an inline year in what was a difficult year, as you all know. And one of the things that's a good segue, actually, Lisa, to that 11% return, because one of the things we want to talk to the committee about that might make sense at some point is we do use this meeting, our beginning of the year meeting, you'll remember, to reset the table in terms of our capital market expectations and what the innate earnings power of the pension plans are given those new assumptions. And I want to share a couple of data points with you on that front, because I do think there might be an opportunity to recast the portfolios a little bit. And we'll show you the reasons why. Anything else from committee members or others? Board members, just on big picture stuff? And again, thanks, Lisa, for that reminder. It just prompt me and stop me if something comes up. So I am gonna skip ahead here, if I could, on governance. So this is, I mentioned, right, the quarter, when we look at our capital market assumptions here, we look at them over a couple of different time frames. They're all long-term time frames, as you can appreciate. And really the biggest takeaway, remember what we talked about with the Fed raising rates for a good part of the first half of the year. The biggest takeaway year over year you see here in the two exhibits on the different outlook periods is a much higher expectation for fixed income returns because those base interest rates are so much higher. And that kind of presents an interesting dynamic for us that we'll share with you in a minute. Equity, global equity returns, you see there in the middle of the page, kind of holding serve, if you will. They're down a little bit on higher valuations and some more modest earnings growth, but not wholesale different than where we were a year ago. And the diversifying real assets and alternatives, you know, kind of about in the general realm. But most pronounced, I think, and most persistent are these year-over-year changes in fixed income. And that has implications, you'll remember, for the allocation of the portfolio. So reminder here, because I know this is a busy, probably a bit of a counterintuitive page. But what we do on this page is we take the baseline asset allocation targets for the pension plans, the existing ones. Those are expressed in the upper left-hand corner of the page, the highlighted blue row there that you see. And on a, you know, kind of look through at the individual asset class level, and using those assumptions or expectations, we build out an expected annual return and some associated volatility and some other metrics there along the way, as you see. And what we're trying to obviously reaffirm year over year is are the portfolios efficient? Are they optimally allocated, kind of given the return objectives that we have? The visual to that is a reminder to the committee, because it's been a year since we last did this. You'll see down on the bottom half of the page there, financial economists call that line that hashes through there the efficient frontier, right? It's intended to show the trade-off between risk and return, and you want portfolios, obviously, that reside on that line. Your portfolio is optimal from a larger allocation perspective. We don't have any concerns whatsoever on that front. But look at the annualized returns that are modeled on a 10 and 20-year basis there in the upper right-hand corner of the page. Your current mix is let's use the 10-year number, an 8% annualized return. Right? That's a median return. It means, right, that half the time, outcomes will be north of that, half the time they'll be south of that. I think we all recognize that there's some variability in those outcomes, but nonetheless, 8% return versus the 6.5% return, right, that the actuaries are kind of holding themselves to. So we've got a little bit of cushion built into the program, and over time, again, because we're using this optimization framework that is focused on the median outcome, we're comfortable having a measure of a cushion there over the stated return objective of 6.5. But let's see, as you work down the list there, what we did is we introduced more fixed income into a couple of mixes, mix 1 and mix 2 there, for example. And you see there, you don't sacrifice modeled return all that much. You do get a nice pickup in terms of the reduction in volatility. And we're still, look at mix 2 as an example, still modeling at only 7.7% and 120 basis points over that 6.5% return. So if you kind of accept that premise that, hey, interest rates are much higher than they've been in quite some time, we think the dynamics around opportunities in the fixed income markets are much improved. And we think we can probably build a program that's slightly more conservative, yet still gives us, obviously, a very reasonable chance to meet our return objectives. So I'm going to translate in a minute, but just keep in the back of your head, we're at 33% fixed income today. We're thinking you have the wherewithal maybe to take the pension plan allegations down to 38%. Or up to 38%, excuse me, sourced from a reduction in equities. And again, as you see on a forecasted basis there, still have an efficient mix of assets, if a slightly less risky one. Let me do this first. I'm going to pause, Lisa, just again. Those can be tough to get through. I know those asset allocation studies, but hopefully people have a general appreciation that we're optimally allocated. There might be an opportunity on the margin to get a little bit more conservative given those higher interest rates and those better fixed income return profiles. And it might be an opportune time in the cycle to de-risk a little bit and not really inhibit the return potential of the programs all that much. Does that, as a kind of a basic takeaway for folks, make sense or intuitive or not?
Yes, I'll open it up to members' questions. Anyone have any? Art, did you want to say something?
No questions here. It's been straightforward so far.
That makes sense. That I like the idea of de-risking.
I guess my only question would be, under the projections, the difference between mix 2 and mix 1 appears to be minimal. So how far do you recommend that we take the de-risking?
I'm going to show you, Bert, that answer right now, if that's okay. We've got a better graphic, I think, that gives you a pragmatic sense of what we would want to do with the portfolios. But good question. Let's see if this works here. Bear with me. Share. I've been on Teams so much, I'm not used to Zoom as much. But do folks see the exhibit here, the current versus proposed?
Yes.
So here's, Bert, to your question, right? Here's the existing mix, obviously, in the middle of the page there. Remember, we talked about 33% are software rounds, but you can see here on a somewhat more a precise basis. So we're 33% fixed income, and then the balance of the portfolio, you'll remember, is predominantly global equities, and then we've got a measure of real assets and some real estate for diversification purposes. And really, the mix 2 that you mentioned is its equivalency here is the proposed target allocations. And you see there, we don't have to make wholesale changes. The model with that change, fixed income to equity, does reposition the global equity program a little bit on the margin there. Interestingly enough, you see there it steps into a bit more U.S. equity at the expense of international equities. So there's a little bit kind of under the hood change there. The real asset positioning stays the same. So really the takeaway here, right, to get to that mix two that you mentioned, this is pragmatically how we would actually, with obviously subject to board approval, this is how we'd move forward with Amy and the team to reposition the three pension plans, right? We would kind of go a little bit more into fixed income at the expense of equities. And you see there under the hood some of the positioning. Two caveats, and I don't want to confuse the issues, but bear with me here. We are ready. MetWest is on watch. You'll remember we talked about that as our last meeting. We generally don't put new fresh capital with managers that are on watch. So what we would propose doing here in a practical sense is while the targets would change to MetWest, and it would be the long-standing expectation from a weighted standpoint, we would take the capital that's actually going to fixed income and we'd put it to work across Western and BlackRock for the time being to get to that 37% and leave a little bit of an underweight, if you will, on MetWest, just again, because they're on watch and we want to refrain from putting capital there until our research team completes their due diligence and follows that process through. So I think that's relatively straightforward. And then you do see, if you work your way down in international equity, we do think it is time to recycle the capital away from Templeton. It's a manager, we've talked about many, many times in the past, had a sterling track record through the 2019 time frame. And since then, they've really struggled to get traction. In talking to our international equity research team, they just they think it's time to pull the trigger and move money out of Templeton. So you see there, had 2/3 of the way down the exhibit, we would eliminate that position. And again, you'd see some of the capital recycled across your program. The Hartford strategy is still fine. And we have the emerging market Vanguard position. So you see kind of the resizings there. So then under the hood, a couple of things. Again, I'm going to stop sharing here.
Chris, before you had 26% in Vanguard. Do you have any internal kind of caps that you won't go more than X% in a certain fund? Because more than a quarter seems like a lot, but
Great question, Todd. And I would say to you, yes and no. And what I mean by that is for an active manager, yes, we generally don't like to have more than 10, 12, maybe 15%, given the nature of the mandate with an active manager. You see that with Western, for example, in fixed income, which is a little bit dialed down, as you know, versus equity. The institutional index is just that, right? It's an index fund. So it's not like we've got active exposure or any type of tracking error exposure or incremental fees. So having that amount of money in Vanguard in an institutional index, we're comfortable with, right, given the nature of the mandate. But great question. And we absolutely do have thresholds in terms of active management size. It's just we kind of release that constraint when we're operating with index funds, if that makes sense.
Yeah, it does. Thanks, Chris.
Hey, Chris, how should we think about the range here in terms of, obviously rates are up, which is probably a good thing with a move like this. I would imagine with fixed income getting a little bit more, but our funding status is still sort of where it is. I would imagine there's sort of a, not a formal cap, but you probably wouldn't want to go too far down this path either, because we still need some juice in the portfolio to get us to a funded level. So how should we think about that in terms of this being a reasonable range?
Yeah, that is a great question. Art, let's do this here because I think I'm pretty sure we include it here. Bear with me here. I'm going to skip around a little bit. So just as a reminder, right, if you look at funded ratios, this came from the Milliman folks, right? And I'm not, so this is the most recent stuff that we had ready access to. So like you said, right, everyone's not 100% funded just yet. Government plan at about 70%, Board of Ed a little north of that, 72%. A little bit stronger funded status for the police plan at 80. I think the way we handle it, Art, is like we talked about earlier. There's a a cushion versus our 6.5, right? 6.5%. I'm not an actuary, so don't. And Todd is, so Todd will correct me when I'm wrong here. But right, the 6.5 achieved, right, is intended to get you fully funded over time. We're not fully funded yet. We know that there's variability in markets, right? That there's other factors that can kind of enter the equation as well. So the way we kind of control or measure for it, to your point, is we're getting more conservative, but we're not getting dramatically so. And we still have that kind of margin of safety in terms of the return profiles we talked about, right? 7 and change versus the 6.5. And that's kind of how we, to your point, are to be measured in terms of not getting way too out over our skis, right? We don't want a market time. We've never talked about that. It doesn't work. Kind of just a marginal change to acknowledge those higher interest rates and fixed income yields, and having that increment to kind of help, right, manage the variability. And we're going to have years, as we all know, right, where we're not going to achieve 6.5 or the 7.5 that we model, and we're going to be north and south of that regularly. So that's I don't know if that makes sense, but that's kind of my thought around how we not get too far, get too conservative, right, at the wrong time, I guess, because you're right.
Okay.
We still do need to earn returns.
Yep. Okay. That's helpful, Chris. Thank you.
Chris, where do you see interest rates going for, one of the things we're going to have to deal with in our budget is how to budget return on an interest investments. I know Glastonbury is using a 4% assumption. I don't know what assumption you're using right now.
For this is, I'm sorry, Lisa, for town cash, you mean?
Yeah, just investment income. Yes.
Yeah. You know what, we looked at yes, but I can get you guys the details because someone, I'm trying to remember, we just went through this exercise with someone. It might have been Carrie Raleigh over in Glastonbury, actually. I don't remember. Do we use stiff in Simsbury, right? So stiff yields are, right, much more compelling than they've been recently. Money market rates are still north of 5%, right? So Amy can go out and buy the government money market fund at principal, right, and get a 5.1, a 5.2% yield. So I think if you use as guideposts, right, where money market rates are, and then you can kind of look at stiff. And again, I don't remember the complexion of town cash, but rates are still pretty compelling, actually. And from a forecasted standpoint, right, I would have every expectation that you're going to get much higher investment income from those types of activities than we've had over the last several years. The caveat, I guess, is to the extent that the Fed does at some point before the year's out begin to reduce rates, right? Those money market rates, as you all know, will in the front end of the yield curve come down pretty sharply in response, right? We've talked about a million times the inverted yield curve and shorter rates being higher than longer dated rates. And obviously that circumstance is not going to last forever. When the Fed does begin to move, that yield curve is going to start to normalize, if you remember, right, more typically where longer dated rates or yields rather are higher than the shorter ones. So it's a little bit of a balancing act, but I would, I guess, Lisa, to answer your question, I would be budgeting higher and using those money market rates and those stiff rates as kind of proxies for, you know, the type of investment income you can get from town cash for the foreseeable future. And Amy knows, obviously, she can track us down and we can help with that exercise if you want to model it out and get some more pointed data to do that work.
Thank you.
So we did talk about 11% returns for the 3 portfolios. I do want to be sensitive to time. I know there's other stuff on the agenda. The only other thing I'd mention, and I won't go through each and every page, it's in your materials, but the OPEB continues to perform well. So if everyone remembers, the OPEB is allocated a little bit differently. We're 65% equities and 35% fixed income. You'll remember we're using all indexed ETFs there, exchange traded funds. And I'm just, bear with me here. I'm going to, instead of flipping you around here and getting everybody dizzy on the screen, The OPEB was up 14.4% in 2024, so had a pretty nice year. Again, remember, it has a bit more equity than the legacy pension plans do, but otherwise performing nicely and kind of allocated consistent with our best thinking. And we've talked in the past, as you know, at $22.5 million now of invested assets, the appetite that the board might have and your subcommittee might have to introduce some active management has been a dialogue we've had in the past. And I don't think it's something we have to move on tonight, honestly, but certainly something we'll continue to bring to your attention. And over time, we might want to weave in a little bit of active management, but it's kind of performing very nicely. And kudos to the town again, right, for forming that thing and funding it up. And you've got one of the bigger OPEB trusts in the state, I think, which is great. So I will, Lisa, stop with that because I know Tyler has stuff he needs to get through. So really the only things for consideration were on the allocation front and that Templeton elimination, if that makes sense to folks. And I'll defer to you folks on the mechanics of that. If we want to, roll the subcommittee back in and have them weigh in, or if we want to act on it, we'll obviously defer to you. It's not, neither of those actions is mission critical, right? If we need to wait a couple of months to get back on cadence with our subcommittee meeting cycle and whatnot, we can do that. But I will stop there and take your direction.
One thing our board can do, we do need to take our actions upon the recommendation of the retirement subcommittee. But if people are comfortable with the recommendations to terminate Templeton and with the reallocation, we could approve it subject to the recommendation of the retirement subcommittee when they meet. So it doesn't then have to come back to us. Can I get thoughts from committee members as to whether they would be comfortable with that?
I'm comfortable.
Yes, I'm comfortable as well.
No problem here.
Okay, so I'm going to state the motion. I will accept a friendly amendment from Chris if I get it wrong. May I have a motion to approve the elimination of Templeton Institutional Foreign Smaller Company Fund and the reallocation of the pension plans as recommended by Fiduciant on page, what was the page of our packet?
I think it's 24.
On page 24 of our agenda packets.
Right.
I'll make that motion.
Oh, let me amend it, subject to the recommendation of the retirement subcommittee.
I'll make the motion with the amendment.
Second.
Any further discussion? All in favor, please say aye.
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 That motion carries. Okay, Chris, you can continue on with Tyler.
Tyler, do you want to, you're going to share, or what do you want to do? I don't think we're getting your volume, Tyler.
Can you hear me okay? Hold on one second.
Yes.
Yeah,
Yes, we hear you.
I think we've got you now, Tyler.
Okay, sorry. Zoom does sometimes have some trouble. I apologize if I go in and out. Really quickly, we'll go through the governance calendar. This quarter is what we call our practice and policy focused quarter. And then next, we're busy at work reviewing fees for our next quarter so that you have a good benchmark to compare your plan to with other plans in the industry. Really quick, I'll go through some regulatory legislative changes, review committee best practices. I did include an investment policy statement. I was informed that there was a change back in 2021, end of 2021, to the investment policy statement. So there's no recommendations to update anything. Our document has not been updated since 2021. And I know you used part of that within the finance committee's investment policy statement. So we'll skip through that and then go to the investments. So feel free to stop me as we go along. This is the one quarter we'll go through what's going on in Capitol Hill and how it impacts your plans. Again, we're focusing on the participant directed assets defined contribution plan. One of the bigger piece of legislation hit last year, beginning part of last year, and there was kind of a rolling effective date for a few provisions, and I wanted to touch on a few just so that you're aware. These are provisions that can impact the retirement plan. The first thing is that's mandatory, and again, this is not something, this is all Mission Square would take care of, and you wouldn't have to manage anything. But the required minimum distributions have been adjusted a bit. So just for edification, required minimum distributions are, when you turn a certain age, the federal government wants you to take the money out of the plan. And they've been adjusted to exclude Roth sources and then given a little bit more flexibility around surviving spouses. So no big changes you need to do starting 1/1. This is all going to be handled by the record keeper. A few of the optional provisions, and I just want to, again, these are not applicable to your plan whatsoever right now, but can if you want to apply them to the retirement plan. The first is if you're providing a mandatory contribution and a matching structure, you can allow employees' student loan payments to count for mandatory contributions or qualification for a match. Again, not something you need to do. This is completely optional, but a lot of our clients are asking, and this would be a scenario where you'd have an employee come to you and say, hey, I can't afford the contribution that goes towards a matching structure. Will you qualify my student loan payments? And that's allowed now in the defined contribution space. The other provision is you can allow people to take $1,000 out per year of the plan for quote unquote emergency purposes or emergency expenses. It's not like a hardship expense, which is a sort of qualified reason. The emergency expense is really for any reason, and you could offer that within the plan as well. You obviously don't have to, because that also can be seen as a plan or a retirement leakage to a certain extent. A couple of the provisions we're seeing a lot of people drawn to is there's one provision where this is allowable for 1/1. You can allow people who may be victims of domestic abuse get access to money to get out of a horrible situation. And so that's a withdrawal that's an optional provision and something that you can offer to plan participants. And then you'd have to potentially change the plan design. And then the other provision is you can roll people out of the plan automatically that have terminated employment. You can actually bump that amount from 5,000 to 7,000, and this just makes the plan economics a little bit better from a pricing standpoint. So these are the few of the provisions for 1/1. Again, the optional provisions are just that. You can decide tomorrow, you can decide next year, you can decide in 10 years to add these provisions, and they are dependent on the record keeper's capability. For example, right now there are some provisions there. I was speaking with folks at Lincoln Financial, and they actually aren't allowing the domestic abuse withdrawals until they get more clarity around that provision, and they're not allowing it until 2025. So again, it depends on the record keeper. I also included some slides around how complex some of these provisions are from left to right, in order from low complexity to high administrative complexity, and then impact being employee impact. We'll probably see the provisions to the left are probably the provisions that more plans will gravitate earlier on before maybe the student loan matching and the sidecar savings plan. I'll pause there. Any thoughts, questions, comments, concerns around the secure provisions? This slide is a great slide because I think a lot of our clients are asking, okay, what is everyone thinking in the industry? What provisions are people running towards? And the reality is most are undecided around the provisions. The provision that's getting the most traction, it was a provision that was offered last year that would allow you to let employees take Simsbury contributions, employer contributions in form of Roth. And even that provision is only 1 in 5 are interested in offering. So again, I think for the most part, if you're undecided, that's par for the course right now. That being said, all it takes is a Wall Street Journal article sometimes, or something that gains traction, and people will start asking, why doesn't the town offer this provision, that provision? The only other regulatory thing I'll update you on is from the long-term part-time all the way to the right does not apply to to governmental plans, unless you have a 401k governmental plan, which is the case of a client of mine, where they do actually have to apply for this. So that doesn't impact your plan. You don't have any socially responsible investments in the plan, but if you were thinking of adding them, we can have a conversation around, as long as the funds perform, the Department of Labor allows for fiduciary committees to have a conversation around environmental, social, or governance factors when selecting investment options. This is very political because it does change with administration, but if that was something you were looking to do, we could definitely now have a conversation around socially responsible investment options per the rule in December 1st. And then all the way to the left, the proposed rule around fiduciaries and how fiduciaries are defined. The fiduciary rule we've been talking about for the last 10 years. The original rule was really to the DOL to protect consumers when advisors are giving advice, and maybe compensated variably for that advice. So if I was to meet with someone and say, hey, you should invest in this fund, XYZ fund, and I was compensated disproportionately for that, I would be required to provide notices to that effect. What they're adding to that rule is around rollovers into other retirement plans and IRAs. Again, so if I was to meet with employees and say, hey, we have the best IRA in the world, I would have to disclose if I was getting compensated more for that advice. This doesn't, I was speaking in hypotheticals, and obviously we don't do that, but a lot of record keepers do. The record keeping industry has made a lot of money recommending IRAs to employees that are no longer employed, and I think that will require more disclosures going forward. I did include some information around litigation, what we're seeing in the industry. I don't want to belabor too much. I think this slide's a decent slide that talks a little bit about where the large lawsuits are what the lawsuits are targeting, what the trends are in litigation. Again, the bottom chart just shows there's twice as many over the last 4 years than there were the 4 years prior. So the industry is seeing more. We're seeing more lawsuits around underperforming target date funds. It's very interesting because those particular lawsuits are the ones I've seen have been fiduciary committees selecting very, very low cost target date funds that may not outperform over a longer period of time. And I think that the lawsuits are now saying, well, hey, we understand you've been worried about fees, but you really got to look at performance, because even though those fees may be really low, the performance of those funds have not been up to par. There's also lawsuits around what's called float income. A lot of record keepers, the Fidelities, the TIAAs, the Mission Squares, the Voyas, etc., have what's called float income in their clearing accounts, meaning when assets are not invested immediately. So during trades, intraday trades, if contributions come in and there's issues applying those contributions, they are held in clearing accounts. When we had zero interest rate environment, that wasn't an issue, but now at higher interest rate environment, there's a lot of money to be made in those clearing accounts. And so what we're doing for next quarter is taking some time and asking what the record keepers do and how they apply that float income, so that you understand. I think the lawsuits are around if a record keeper is keeping that float, is that a fee, and is that a fee that committees need to look at? So understanding what they do with float amounts is important given where rates are. And then the typical, not getting access to the lowest share costs of investments has been a low-hanging fruit for a lot of litigators out there. If you're a $1 billion plan and you still have retail share investment options, that's an easy thing to prove that a fiduciary wasn't doing their duty as a prudent governor of the plan. And then again, I won't go too much into this slide. It's just, IBM actually, news last year, IBM decided to go back to pensions. And so our cash balance plans, I think that sent ripples around the industry around, okay, that's why is one of the largest defined contribution plans now changing their employer contributions to go into a defined benefit like investment option. I include this every year, just fiduciary best practices. Again, I think these committees are following this. Our governance calendar is built around this. Having a quorum, building out understanding, communication, education, plan design, evaluating record keepers, which was done during the RFP process, making sure fees are reasonable. And last quarter, we spent a little time, and I'm sure Art appreciated talking about cyber protocols, making sure that cybersecurity is up to par with the record keeper. So all things good there. Again, I included this investment policy statement. You have one, so no need to review or approve this one. The investment policy statement that you have is all set. When we look at balances, up from, as Chris mentioned, the performance of capital markets helped up from close to 14 million end of March to almost 16 million end of December. A bulk of the assets, a combination of the S&P 500, plus the sort of protection of principal or stable value vehicle, and the target date fund investment options. We do have, this is the 457 plan. The Board of Ed plan is this plan here, up from 1.3 to 1.5, and then the 401A plan up from about close to $1 million to 1.3 or so. Again, the newer plans, more people are gravitating towards the target date funds as opposed to the 457, which I think we introduced the target date funds a little later on. You include the T. Rowe Price target date funds. We include this slide every year just in case there's any changes to the team or how they build out the glide path, which there was not. And what you'll see here, we have those funds on maintain. We don't recommend any changes. You see the performance longer term has been top decile, top performing fund across the board against peers. Some slight underperformance here. Some of their value growth positioning on the longer, further away dated funds, but for the most part, longer term still performing in line with expectations. Chris touched on, Western Asset funds performed well longer term. MFS struggled a little bit in the 1 year, but again, longer term still performing, outperforming peers, outperforming the index. And then the rest of the core menu. Large cap should be T. Rowe Price growth stock. We meet with Joe Fath out in Baltimore, who runs that portfolio. They struggled a little bit back in 2022, bounced back pretty significantly in 2023, and so we're still giving them some room. Their positioning was not owning cyclicals and not owning energy back in 2022 hurt them a little bit, and that's weighing a little bit on the longer term. But no recommendations to change, and we still have maintain on the majority of the portfolio. So no recommendations to change anything. We also show you annualized performance here, and I will pause there to see if there's any questions.
Thanks, Tyler and Chris, both excellent as usual. I'll open it up to questions from board members.
Hey, Tyler, just a quick question. I know it's sort of a hard one, but how do you think about particularly that T. Rowe one where there was a lot of red on the page? So I'm I'm a fiduciary in another space, and it's always a little tricky when you see the reds. Is it that you do sort of that additional due diligence and that gets us comfortable? Do we sort of have them on watch? Like, how do you think about those, and when would a recommendation come through?
So we get that question a lot. So you have, we'll put a fund on watch that's all top quartile, and we've had changes to the team, and you see obviously the bottom 10-year. A lot of that, I think, coming over the 3-year returns, we still believe in their process, but getting a little bit more detail into the performance there, it was some of the misreading of the Magnificent Seven. So T Rowe has been notorious underweight Apple, and that weighed a little bit on performance. And so when you're so concentrated and you see an active manager that typically doesn't want to be that overweight some of these bigger Magnificent Seven stocks, we don't necessarily fault them too much for it, but it's definitely an art with our research group. They take that very seriously when you have sort of bottom half 5-10-year numbers. You see a lot of that again when you look at the annualized number, and I'll show it to you here. You can see a lot of it's coming off of just 2022, and I'll show you here. Joe has been pretty consistent over the years. This 2022 number, not owning energy, not owning cyclicals, which is something we don't expect him to own, and then being perennially underweight Apple, and they kind of missed Tesla a little bit, which is weighing on I think that performance over the 2022 year, but longer term and the consistency is enough for us to keep it on maintain, but still obviously closely monitor performance and the team there.
Okay, that's helpful. Thanks, Tyler.
I might add, Art, just quickly, one of the things, because the way Tyler explained it is spot on, but I think the other thing we charge the analysts with is when they do research a manager and present it to our forum for approval and use in client accounts, they have a pretty deep understanding of kind of the complexion of that track record through a different market cycle, right? And when the manager would outperform, maybe might struggle a little bit given the backdrop they're investing against. And I think really the trigger for us, to your question on a watch status, when there's a disconnect between the way the analyst understands the strategy and when things would go well or not, and that's not happening, that'll often flash a red light, right? That, hey, there's something here amiss, and we're going to dive a little bit deeper. And then I think Tyler answered it, but managers go on watch, they're only allowed to be on watch for 3 quarters. And then either we've kind of researched and they're ready to move back to maintain, or it's time to recycle the capital.
Okay. Thank you, Chris.
Anyone else? Okay, Tyler, back to you.
That's all I had for today.
Well, Chris and Tyler, thank you very much. I thought your reports were excellent. We enjoy them, and your presentation was very helpful in understanding. We appreciate all the work you do, so thank you for joining us. We do have one quick motion under this section, and that is to formally appoint Bert and Todd to the Retirement Subcommittee. We forgot to do that in December, and do want to take a motion to do that. Bert and Todd have been on the subcommittee. I just want to let Art know. Everyone else knows that any member of our board can attend the retirement subcommittee and has full opportunity to ask questions and participate. So it's just a formal thing, but it doesn't diminish your ability to participate in the retirement subcommittee meetings. So with that, may I have a motion to appoint Todd and Bert, or Todd Burke and Robert Helfand, to the retirement subcommittee?
So moved.
Any further discussion? All in favor? Please say aye.
Aye.
Any opposed? That motion passes unanimously. All right. Well, thank you, Chris and Tyler. We appreciate all you do, and we'll see you, I think, next in May. Is that correct?
Absolutely. Thank you, folks.
Okay. Take care.
Thank you.
Have a good night. Bye.
Good night. All right, we will then move on to the finance director's report, which are on page 86 and 88 of your packets. And I'll turn it over to Amy to walk us through what you have.
Okay, so page 86 into page 87. So the first few sections are just the recurring listing of supplemental appropriations that have been made during the year, any new grants that have been awarded or approved during the year, and then the new section, which is just their savings initiative. So I reach out to the department heads prior to the meeting and get any feedback from them on anything that they may be working on. I'm not going to go through those things individually, so if you have any questions, I can take those or further look into something if you would like. Otherwise, I'm just going to move on to our post-employment benefit trust fund section.
I'm going to stop you for a second and congratulate you and the Board of Ed and Town Clerk on the savings initiatives. We really appreciate all you do on that. And it's great to have those reported on a monthly basis. That's a little bit of a change, and we're really happy to see that and just want to publicly acknowledge the work town staff is doing to communicate those savings initiatives and to actually do them. So thank you for that. Okay, Amy.
Thank you. So on the other post-employment benefits trust fund, this is we call it our OPEB trust fund. For those that may be new, this is a trust fund that holds the health insurance and life insurance for any of our retirees. So it's similar to the pension trust fund in that contributions are made into the fund, and those investments are managed by fiducian, as you just heard. So currently we are not utilizing our OPEB trust fund. We've been building up the funds over several years. The members make contributions, the town makes its contribution, but we've never actually paid out any claims for our retirees from this fund. And now that we are 100% funded, it's Milliman's recommendation that we actually start utilizing the fund for its intended purpose and start pulling out those health insurance claims on probably a quarterly basis and start utilizing that fund. So this is something that you'll likely see during the fiscal year 25 budget process. Right now, all of our retiree premiums, the town share as well as the retiree share, go into our health insurance fund, and all of our health insurance fund claims are paid out of the health insurance fund. So now we're going to change it where it's only going to be active employees that are going to be going into the health insurance fund, and any premiums from our retirees are going to go into the OPEB trust fund, and then those claims associated with our retirees will come out of the OPEB trust fund. In talking with Jen from Milliman, everything works the same way as it currently does with the pension trust. She calculates it every year, and then we make our annually required contribution. So aside from just moving the premiums and where they're allocated and where the claims are coming out of, there's no change in our current practice. Any questions on that?
Amy, I had a question. In the health fund, when we've been paying the claims out of that, but our retirees are putting money into that, has there been sufficient money put in from our retirees to cover their claims, or have we had to dip into some of
we've ever done an analysis just on the retirees, and when Locked In, our benefits advisors, looks at that fund, they look at it as a whole. So they look at the premiums going in as a whole and then the claims going out. I don't think we've ever spiked out an analysis of retiree premiums to retiree claims, but we could have Locked In look into that if you're interested.
Thank you. Open it up to questions from board members. Bert?
Yeah, I apologize, but I'm still confused about the precise nature of the various funds. So where are the contributions to the OPEB trust fund coming from?
So part of them come from the retiree, part of them come from the town. So there's a cost share. So
they come from the retiree in the form of what? They're not their contributions, their deductions from payroll. How are they characterized? Are they separate OPEB contributions?
So they have a couple of different options. So when an employee retires and they're able to stay on the town health insurance, they get their premium benefit from the pension fund. So they're taking their pension from our pension fund like they're supposed to as a retiree, and a portion of that will be deducted for their health insurance, and that will come to the town. Or if the retiree chooses, we just bill them on a quarterly basis. And this is how much you owe of our premium. And then the town kicks in their share, and then it goes into the health insurance fund currently. And then on the annual required contribution, that works the exact same way that the pension funds do. Each year, Milliman calculates how much the town needs to contribute into the fund, and we pay that contribution into the fund. So those are the two sources going into the OPEB trust fund.
Thank you.
You're welcome. Any other questions? Okay. Moving down to the Latimer Lane bond issuance. So our Latimer Lane school renovation project has been ongoing for quite some time. As some of you may recall, we had our first debt issuance in 2023 for a half of the cost of the project. And then in 2024, we'll have the second half of the bond issuance. I'm sorry, less our grants. We don't bond for the grant portion that comes from the state. So just with the portion that the town is responsible for. So that's about $12 million. Lisa had me take a look to see, just for those that are new again, last year we utilized about $3 million of our capital reserves, and we paid for our capital funding and did not issue bonds for that. So that was quite a significant savings last year to kind of minimize the debt impact in the future years. So in a similar manner, we did the same thing this year to see what it would look like if we utilize those reserves instead of bonding for the full 12 million. In doing the calculation, if we used about $1 million of reserves to offset our bonding for the fiscal year 25 budget, it's only about $90,000 savings. So not like a huge bang for your buck for like $1 million, but if we did $1 million, $2 million, $3 million, then you get into about, $300,000-$400,000 depending on how much you're willing to utilize. We'll give you the exact figures as we get into the budget season. But just to give you a sense of where the reserves can be used to have some impact on the debt service, $1 million equals about $90,000 of relief. Any questions on that?
Amy, that's because that's a 20-year bond, right? And a 10-year bond, when last time we did it with the 10-year bonds had a bigger bang for your buck, which is I forgot about that. But one of the things, do we have an option of any debt that is going to be paid off in 4 years that we could pay off early and get, or it's not worth it because that earlier debt has a lower interest rate?
So I think that we would have to do a refunding to that. And I would have to check with our bond counsel to see if we're even allowed to pay it off early. I don't think so, just because with the bond, people bought those bonds and we're promising them a return every year. It's something I can look into as far as logistics from our bond attorney, but I think we'd have to do a refunding in order to do that.
Okay, thank you. And just members of the public, Amy might not understand, especially what with Chris said about why don't we just bond in advance, keep the money in reserves and earn a high interest on the bond rate. And that's because we're not allowed to. I don't know if you want to talk about that, but the public might be wondering why we're not doing that. There's actually a legal reason. So
yeah, within our bonding constrictions, we are not allowed to borrow early and hold on to that money, especially because that money is typically earning investment income. So you're not allowed to earn any investment income, and you're not allowed to hold on to the money for, was it 2 years or 3 years, 18 months, something along those lines. I don't know it off the top of my head, but there are very tight restrictions to make sure that you're not utilizing that money in any manner that would gain you any benefit to which the IRS does not get a part of.
Right, we could get the benefit, but we'd have to pay it back to the federal government. It's right. So it's not. That's why we don't do that. If the public is wondering.
Just 2 other quick updates Lisa had wanted me to mention because our meeting was canceled last time, so this was in your packet prior, but just so that we can say it out loud. So for the assessor's office audit, the auditors were on, the consultants, were on site in October. They gathered a bunch of information. They took back to their office. They started working independently on those materials, and then they reviewed our reval. since our grand list busy season is over, they're scheduled to come back out in February, I believe, within the next couple of weeks or so. And then they are setting up one-on-one individual meetings with staff to start going through what our processes look like, recommendations for process improvements, and then hopefully have a report for us within the next 60 days, I'm hoping.
Great.
And then just the last thing, our audit, we're in the final stages of our audit. We had a new GASB standard that had to be implemented again this year. Hopefully we won't have any more for a while now. And everything is in their final review stages. So we should be getting that report within the next couple of weeks. I think they have like 5 review stages and then the final report processing. So I had talked to our manager today and she said it should be coming within the next couple of weeks.
Amy, when that does come in, can you email us a copy of? Thank you.
Yeah, I won't wait until the next meeting.
And also, Amy, our board is aware, but the public may not be aware of where the grand list came in. And can you talk about that and sort of why it changed?
Yeah, sure. So for our grand list, we had a reval last year. So as is typical, I don't know if people know that your grand list, the amount of growth is usually not that great, or it actually can end up declining. For our grand list this year actually remained pretty flat compared to last year. Our real estate had a 0.54% increase. Unfortunately, our motor vehicles went down about 4.88%. So those that you may have been following, the market values associated with automotives, it was at a record high last year. You couldn't get inventory, you couldn't buy a car, you were way overpaying, and that is starting to level off. So those market values that came in from the DMV that we do assess based on, those are starting to decline. So unfortunately, we did see a decline in our anticipated motor vehicle. And then our personal property just went up about 0.02%, so pretty consistent from year to year. The overall increase in our grand list is 0.06%. And if you were to translate that at our current mill rate, it's really only about a $60,000 increase in dollar value.
Okay. And Amy, and we're required to file a report with the state. Is it possible to get a copy of that report that was filed, or is it?
So Francine texted me right before the meeting. She asked if we were meeting tonight, and I'm like, I can't put that together in 10 minutes, but she has those reports, and I told her I would send them out to you guys tomorrow.
Oh, you're the best. Thank you. All right. And I'll open it up to questions from the board. No?
I don't know if this is the right time to raise it, but in the packets we had for the January meeting that we canceled, we had year-to-date projections that included a substantial deficit from the Board of Education and a substantial surplus from the town. Where do we stand on those projections now, or is that something you're going to touch on later?
If Lisa wants me to get to the next item, I can talk about that right now.
Go for it.
All right. So on the town quarterly report, is it easier if I share my screen?
Please.
Everybody can see that.
Yes.
Okay, this is the same report that's in your packet, just on the screen in digital form. So you can see that for the period ending December 31st, 2023, we're anticipating about 125 million in revenues at the end of fiscal year 24. And this compared to your budget here of 121 million, we're anticipated to be about 3.3 million to the good on the revenue side. So just taking you through a few of the areas as to what caused that. In our tax department, we have our current year taxes, previous year taxes, interest and liens, things of that nature. This is mainly the 692,000 in excess of budget is mainly because you're the budgeted tax collection rate at 98.5%, when we typically collect about 99.5%. Our present collections to date are about 67%, which is consistent with the same time period last year. So right on track where we think that we're going to end up. Our investment income under the finance department projections are expected to be in excess of budget of about 1.7 million. And this is just based on the 2 quarters of interest to date that we've received. Might actually be a little bit conservative, but I think that's a solid number that we can bank on for the end of the year. The town manager's office, this is money that we've received, 692,000 of this budget surplus of about 700,000 is related to their municipal revenue sharing program that is allocated to the towns. I believe this will be our 3rd year getting the allocation. It's one of their special municipal revenue sharing programs where they calculate the sales tax, and they don't have us budget for it because depending on where the sales tax surplus lands, and then it's allocated to each of the Connecticut towns. So again, this is our 3rd year getting it. So unanticipated revenue of about $692,000 there. The planning department, this one we talked about last quarter, but just a reminder, it's our performance bond that we called on the Cambridge Crossing property. The $60,000 in insurance refunds, we typically take part in a Kermer pool. And if claims are good and they have a good year, they kind of redistribute those savings to the members. Unfortunately, they had a really challenging year with one of their municipalities. I believe it was a school. And that pool, they are no longer distributing to the town. They are utilizing that pool in order to keep their rates low. So we will not be getting a distribution for this year and likely not getting a distribution for next year as well. And then moving down to the Board of Education, we had some increased tuition paying students. The last couple of years, we've seen some increase in Heartland students that are attending our programs in Simsbury. So that has been a nice surprise over the last couple of years. Moving on to expenditures.
Let's stop. Can we stop at revenues and take questions here first? I'll open it up to questions from members of the board first. If there are any?
Well, really quickly on the investment income, Amy, what do we have that invested in?
So we have that invested in STIF, as Chris had mentioned, and then we also have it in our Liberty money market account. STIF is typically better in that nature, but Liberty is very good to us, so they give us a slight overage in rate compared to STIF. So we typically try to keep our money in money market.
How much do we have there, Amy?
In money market, it fluctuates, but usually around 30 million, and then probably another 15 to 20 million in STIF.
Bert or Todd? I had a question just on the tax the top line there. The 692 in September, we were projecting about 900,000. If you think that we're actually going to get 99.5, what's the reason this number is low? I think I know the answer, that it incorporates not just the tax collection assumption, right, that other stuff, but if you could walk us through that.
Yeah, so in September, there's just not enough data to give me strong projections. So I just take whatever the difference is in the tax collection rate at the point that we're at compared to what the budget was. And that was around 800-900. And then looking at it after the first 2 quarters, I also take a look at where we are showing on our interest and liens, where we're showing on our prior year tax collections. And I believe there's one more line item included in that. Likely we will be closer to the perhaps like $800,000 range. But I was just conservative just because it wasn't showing quite as fruitful as in years past when it came to the interest and liens.
Perfect. So when the public often asks us about that, the tax collection assumption rate, it's actually more than the tax collection assumption rate, which is why it's not coming in at 1.2 million if it were
Right.
1%.
Exactly.
Okay. If there are no further questions, we'll go on to expenditures.
So on the expenditure side, anticipated to end about 120,758,000, and this in comparison to our budget of 121,698,000. There are anticipated savings about $940,000. Hold on one second. Here's one at the door. So if we start at the top, we have the town manager's office, the planning department. We have savings about $75,000 and $92,000 related to some staffing vacancies. We have some contracted services savings, in the assessor's office. So this is something that we put $50,000 a year in the budget for personal property audits. The cost for those audits was a little bit less than intended, so we're only going to spend a portion of that money this year, and then you'll actually see a reduction in the budget next year, close to around that 17,000, because we don't need the full 50,000 going forward. Let's see, more staffing vacancies, police and dispatch. I'll talk about those in a second. The highway, the building, utilities, we're seeing some savings mainly with electricity. Staffing vacancies in social services, library. I'll get to the Board of Education in a second, and then the health insurance and employee benefits related to those staffing vacancies. So related to the staffing vacancies, we saw that there's some in town manager, planning, police, highway, and library. The town manager has obviously been filled. He's here. Planning vacancies have been filled. Police department vacancies are still open. Highway has been partially filled, and library just opened. So I think it's safe to say that we will probably see some savings through the rest of the year this year, and we'll look to reevaluate for fiscal year 25 if any of those vacancies may be recurring, since those were positions in planning and town manager specifically that have gone unfilled for quite some time. So if all of this comes to fruition between our revenue surplus and our expenditure savings, we will have a surplus of about 4.2 million, which will bring our estimated fund balance to about 19.59% of fund balance. Now going back up to the Board of Education and its deficit. The Board of Education is anticipated to have a deficit of about $500,000 to $700,000, mainly related to special education. I don't know if you all have had a chance to review their January 9th meeting on special education. I think the Pupil Services Director did an amazing job of laying out our struggles and where we're seeing major issues. But last year, if you may recall, during the budget process, we added about $500,000 to the budget for out-of-district tuitions, contracted services, etc. Unfortunately, going into this year, when we received our rate increases for these vendors, it was anywhere between a 10, 15, 20% increase. So that pretty much ate up about $400,000. It's like we never even put it into the budget. And then on top of that, you'll remember when we reported out at the end of fiscal year 23, we had some transportation issues related to our current transportation contract, where he was having issues finding drivers. And then we had to outsource to a third party for those transportation services. And the costs associated with those were quite significant. In order to mitigate this deficit, we will be looking at spending freeze as we do every year, reallocating some of our grant funds that may have special programs associated with them that we can reallocate. And then, as I had mentioned earlier with revenues, we had some additional tuition, so that might help as well. Any questions on expenditures?
This might be a question for us to address later, but when we have a net good guy, like it sounds like we have this year of whatever you said, Amy, 4.3 or 4.4, how does that work going into the next year? Like, do we try to spread that good guy to give us a benefit going into the next year, or do we just look at it year to year and don't sort of take credit for the fact that we had, a better result this year than we expected?
Well, that is something for you all to take a look at. But typically what we've done is at the end of the year when we have a surplus, we typically take it into our capital reserve fund to try to offset any major capital expenditures in the next year. Or like last year we should actually change it to a mill rate stabilization fund, because like last year we try to utilize some of that savings to offset our debt service and try to keep that mill rate solid. So that's at the discretion of the board, but typically it goes into capital reserve to reevaluate during the next budget cycle. I don't know if Lisa has anything to add to that.
I'm just going to add to that a little bit. I thought that was an excellent description, Amy. We kind of follow the Massachusetts model. So we think we have this money, $4 million, but we generally wait till October when we know we have the money, when the book's closed. And at that point, the money then goes into the following year's budget consideration. So when we closed the books in 2023, in October, we had savings. That money went into capital reserves and can be utilized in 2025. When 2024 closes in October, the money you're seeing here would then typically be used in 2026. It would go into capital reserves once you actually have the money and it's been certified. Our charter does permit, and I'm sure Mark is well aware, that he can make line item transfers within departments. So some of those savings within the departments might be moved around. So it might be less, it might be more. He can't do a new capital project. He can't create a new appropriation. But if salt is running low and materials and public works are running high, he can do a transfer within a department. Transfers between departments require this board's approval. But that's why I'm hesitant to do that. Mark, you're new. You're going to be looking at department's needs, and I just want to make sure we have some new board members. We understand our authority. Mark is fully allowed to do that upon the approval of the Board of Selectmen without the Board of Finance within departments. So just one caution there. And I don't know, Mark, if you want to talk about, because it looks like it's 900,000 to the good, but it's really 1.6 million for the Board of Selectmen, which is very, very high. A lot of it's due to vacancy rates. We understand that, but I don't know if you want to speak to that.
Just to that point, Chair, I think you get closer to 1.4, 1.5, but with respect to my authority to do intra-department transfers, you certainly would be making the board through Amy aware of anything that we were doing in that regard. But, we are working diligently on the budget for next year. And, these numbers, apart from the Board of Ed, quite encouraging. You do see a repeat of some of the problems on the Board of Ed side that we saw last year, which obviously is going to continue to be problematic for the town. But the intra-department transfers could be helpful, as we work through budget challenges, and we'll certainly keep the board fully informed. Thanks, Chair.
Are there any other questions on expenditure? Amy, just going to the Culture, Parks and Rec, I just had a question on their budget. Looks like things are a little tight. I wasn't sure if that's related to the pension shift from our actuary.
No, so do you mean on the Parks and Rec fund or the general fund Parks and Rec section?
I mean, line 63 to 60.
Okay. So at the end of the budget season last year, the Board of Selectmen, I believe, had put forth 2 or 3 positions, something of that nature. And the Board of Finance had granted them one position. They were trying to choose between a mechanic and a parks maintainer. So the Board of Finance put that in the contingency line item for the Board of Selectmen to then go back and choose between those 2 positions. So the funding for that position is sitting in the contingency line item of the $382,000. So, but the expense is actually being recorded in the correct spot in the department of the fund.
Oh, okay. So we had talked about last year, maybe doing those transfers mid-year instead of waiting to year end, or what's your
Okay.
thing? Maybe for our next meeting, we could do that just to clean it up or before we get to our next quarterly. But thank you for that. I had forgotten about that.
Hey, Lisa, let me ask my question maybe a little bit differently, just so I'm clear. So I guess, and, you know, I could call this a hypothetical situation, but it's kind of our situation right now where, you know, the year where we had a pretty significant tax increase, and then, you know, we're obviously in our normal process of trying to get the budget right. Can any of that 4 million get used to be any consideration in the process so that we could limit how much we're going to increase? You know, even if it wasn't all of it, obviously, right? But like, is there any way that that could come into play? I guess is my question.
Yeah, so but it would go into how comfortable we are with how reliable that number is. And then
I got you.
and then the other thing, it goes into how much is going to be available in the 2026 budget for capital, because this is actually planned. I mean, it's a little more than we planned, return to the general fund, but to some degree, we planned for that because that's how you fund capital in the 2026 year. So we can use it, but then that depletes what's available in 2026. So it's a use, but with caution, I guess. How's that?
Yeah. Okay. That's fair.
Mark or Amy, I don't know if you want to weigh in on that, whether it's advisable or when it would be advisable when we'd have a number that, or maybe that's to come in March.
Yeah, I think we'll take a pass on that one for now, Chair. Obviously, we're still wrestling with it internally, as I know the board will be once the budget is released to both to the BOS and the BOF. So, but Art, that's certainly the key question, you know, that we're wrestling with internally as well, and we'll be prepared to get into that and defend our decisions. But obviously, it's a middle of the road approach, keeping in mind what you just heard, that it would impact what would be available for capital in 26. So, but it's a key question. So thanks for bringing that forward.
Got it. Thank you.
So the only question I have relating to this is these numbers are all as of December 31st. Amy, are you seeing anything in January that moves us in one or another?
No, January hasn't, there's nothing been brought to my attention of a significant nature. So I think that these numbers are pretty solid even through the end of January. For some of the other funds, I think it'll change in January into February, and I'll get to that when we get to the next fund. But for the general fund, the revenues that we've already received, or we already know they're going to be received. So those are pretty solid. And the staff and vacancies, it's just a matter of timing for when they're filled, which will translate to savings or not. And of course, you know, who's hired in their place, somebody at a higher salary, lower salary, things of that nature. So nothing major in January outside of the things that are already included in here. So I think that it's pretty solid through the end of January as well.
One of the things, Art, to your point, we did ask, or I mean, Bert, to your point, Amy is going to get us a quarterly for April, so we'll have tighter numbers at that point, closer to where we want to be. We probably will not have them on the date of the hearing because that's too close, but we should have them on our final decision making on, I think, April 16th when we do that meeting. So we'll have that. But obviously, Bert, to your point, that's something we should be monitoring very closely, especially if there's any intent to use it and not wait until 2026. Are we ready to move on beyond expenditures? Any other questions on this? Okay, Amy, go ahead.
Okay, moving on to the Simsbury Farms Fund. You'll see the projections for the revenue is pretty consistent with the budget. So the reason for this is because the kids have not started registering for camps at this point. So as we get more of the revenue, more of the winter season, going into the next quarter, we'll have a better basis as to where we're going to land as far as the number of programs, the number of participants. So I kept everything pretty much consistent with budget right now until we get more of that data. And then just down onto the expenditure side, not really anything of significance. There was a little bit of salary savings here. So we are anticipating a deficit in this fund of about $334,000. But as you may recall, if you take a look at the budget, we were already budgeting for a deficit of about $370,000. This is from the Farms Fund having a good year last year, I believe. And the year before, they had able to build up some of their fund balance, and they were actually able to use some of their fund balance and some of their reserves to offset their capital expenditures for fiscal year 24. So that was a planned use of fund balance going into fiscal year 24. Anything on that? Okay, and then our last big fund that we like to take a look at is our health insurance fund. Projections for the year, about 16 million in revenues. Compared to budget, it looks a little wonky. It's about a $2 million difference, but I think this is during the budgeting process. We had expected a 15% increase in premiums in the beginning when we were working with our benefits advisors. And I don't think these numbers were updated after that when we came in at a lower increase. So as you can see, it looks wonky, about $2 million off, but if you look at it compared to our expenditures and where we're anticipated to be, we're still anticipated to add to the fund about $680,000. So when we do our transfers next month, I can make that adjustment as well. So like I said, claims are coming in, or like I said, we're coming in about $680,000 to the good. If you took a look at the claims line item, we're anticipated to be about 2.7 to the good. A great claims year coming out of a huge claims year where everybody was coming out of COVID and getting their procedures done and going back to the doctor. And we saw a huge spike those last couple of years, which is where we had the 15 and 8% increases. And now we're finally starting to come down with that. And as you saw during our tri-board meeting with our fixed costs, our benefits advisors is only recommending a 3% increase this year, which is huge compared to the last few years. And I actually think it's going to end up going down to about a 1.7% increase. So some great news on the health insurance fund. If we take a look at our reserves and where we're anticipated to be at the end of fiscal year 24, about 4.1 million in reserves. And then our claims that have been incurred but not reported, about 982,000. That counts as part of our reserves, which gives us reserves of just over $5 million. And this is about 36% of expected claims. And our benefits advisors tell us that we should be at 20 to 25% of expected claims. So we are definitely in a good position here going into the budget season. Perhaps we could utilize some of these funds to try to help the operating budget, or we could continue to grow them and use them for something else, but just a good position to be in for a topic of discussion going into the next budget.
Amy, our current policy permits us to use a third of excess, right? So not the full amount.
Right.
So what kind of dollars are we talking about that could be used, and what kind of impact could that have?
I believe it was, of course, that's what here we go. So if we used about $900,000, that gets us to 30% of expected claims. And then if we go down to 25% of reserves, we could use about 1.6 million. And then if we use a portion of it, I think I had done like 70% or something, about 1.1 million or 600,000. So probably anywhere from like $500,000 to $1 million, depending on what the board is comfortable with. Because this is 25%, I'm sorry. So it gives you a little bit extra if you were willing to go down to that 20%. So anywhere between like $500,000 and $1 million is probably realistic without running the actual numbers.
Right, but just if we just used a third of the excess, it would only be about 5% we could use. It would be closer to the 30%, right? Which is our current policy.
Right. So that's all I have on our major funds. I don't know if anybody else had any questions on the smaller funds.
Did you do sewer?
I did not. Do you want me to go through sewer?
Yeah.
Sure. So on our sewer fund, revenue is about 4.4 million compared to our budget of about 4.2 million. Again, here we have some additional interest income just based on the last 2 quarters. We were far going to exceed our budget of $8,000. So about $123,000 surplus there. And then for our assessments, Tony's typically conservative in this budget of about 156,000 in excess of budget for this year, which is probably typical for what we see each year. So about $268,000 to the good on the revenue side. And then on the expenditure side, again, we have some staffing vacancies here. Those are getting filled and should be filled by the end of the year. I know a couple transitions recently that took place. And then our utilities, again, we're showing savings in this fund as well. I'm not sure off the top of my head what these utilities are. I would assume it's part of the electricity, but that seems kind of high. So I'll actually double check that one. If it's unrelated, I'll let you know. Capital project fund transfer debt. Then this gets us to about $852,000 deficit for the fund. And of course, if you look over here, we actually anticipated a 1.5% deficit to try to utilize some of those reserves, which is attributable to the capital projects that come out of this fund. So for those of you that are new, the sewer use fund supports itself and supports its own capital projects using sewer use fees. So any capital that they do, they utilize their own funds, but they're transferred into the capital projects fund to complete the capital project. So that 1.4 million is their way of utilizing their reserves to pay for some of their capital infrastructure.
Amy, is that the reason why their reserve level is so high? It's quite a bit.
No, I haven't been made aware of any specific plans, but I've mentioned this to Tony several times because it has been a topic of discussion. And we previously had a clean water fund loan where the state mandated major facility changes to our sewer building and sewer department. And we took out a clean water fund loan at 2% for that. So building up their fund balance, there is going to be another state mandate coming. I'm not sure on the timeline for that, where they have to restructure again. And so instead of paying debt for that, part of their plan is to utilize these reserves that have been building up to pay for a portion of that.
Thank you.
Any other questions? Okay. I have the Board of Education quarterly in here. I don't know if you want me to go through it or if you just want me to take questions on it, just because there's probably more information what I just provided you as far as the deficit, the reason for the deficit and what we're doing, as opposed to just their year-to-date budget to actual. So I will take your lead on whatever you want me to do related to that.
Why don't we finish the town side and go through capital, and then we'll go through the Board of Ed quarterly?
Sure. Do you have any other questions on the smaller funds?
The same question I had was sewer. Is residential properties has a very high fund balance. Is there a plan for that as well?
Yeah, that I'm not sure. I'll follow up with Tom Roy on that. He kind of manages all of our town properties that we rent out. I don't know if there's any major renovations or anything coming or what the state of the state is on that. So I'll get an update from Tom Roy on that and report back.
Did everyone have a chance to read the minor fund? When you say minor funds, just for the public, can you just give a broad idea? Those are special revenue funds, trusts.
Yeah, so those are our smaller funds that don't have an impact on our operating budget. There's everything outside of the operating budget. I don't want to say small dollars, but smaller dollars that are typically driven by grants, donations, things of a special interest nature.
We just heard an update on our trusts and OPEB funds, so those are also included there if the public wants to look at them. Well, then why don't we turn to capital if there are no further questions on the minor fund?
So the capital project sheet, right before the meeting, I had sent out an update. We typically provide the inception year of the project, which was hidden and did not print. So we resent that out to everybody. On your CIP, just looking through, the one that sticks out, the berm improvements, this is something that was on hold. It was supposed to be funded by a grant. The grant was not approved, and so that is the only one that's basically on hold. The expected completion dates are associated with the other projects. I don't think I have anything of major to report out. There might be some stuff coming during the budget process that some of the department heads will want to talk about, but as far as right now and overspending or anything of that nature, I don't have anything specific to report unless somebody has any specific questions.
Any questions from board members? Just for members of the public, the reason we, oh my gosh, I'm sorry. The reason why we ask for inception date is because we have an obligation to make sure that the funds are spent. If they aren't spent within 3 years, they revert. The money goes away. So that's one of the things we're charged with monitoring, but it's also a nice planning document. You'll see some of the capital projects start in 2017 and are going to be completed this year or next year. And the question is always why. And sometimes it's because of the permitting you have to get from the federal government, and sometimes for other reasons, but it's something to monitor and observe because it goes to the planning. If the project was approved in 2017, did it need to be funded fully in 2017, or was there an opportunity to spread that funding over a longer period of time just for management of debt service and how we plan for our capital? That's just one thing we look at. So Amy, thank you for providing that. I'm going to go on to CNR if there are no CIP questions.
So if you all are ready for CNR, again, like Lisa mentioned, we have the inception year, which those funds do expire after 3 years per our policy. So they get returned back to whatever funding source they came from if they're not spent. For the newer members, there is a policy that allows the department head to overspend by about $5,000, and then we clean it up at year end. There's nobody in that position where they're over that threshold right now, so everything is pretty status quo. There's a couple small overages. I see one for about $200, another one for about $2,500, but none over that $5,000 threshold. I don't know if there's questions on any specific projects.
What page are we on?
132 CNR starts.
Do you want to pull that up, Amy, just so folks can see what we're talking about?
I think this one's easier to read on paper.
Yeah, this one's a big one. So this is the CNR. Then you have your inception year, you have the project, you have the amount of the appropriation, any expenditures in prior years, expenditures in current year to get your total spend to date, and then your available balance going into after December 31st, 2023. And then here's where you would see any of those overages, if there are any. So here's a small one for $237 that I mentioned. Here's one for about $2,500 within the Board of Finance policy.
I mean, there's one on the wayfinding signage in fiscal year 2021, which would have been approved in May 2020 with no expenditures. Is that one that's going to revert?
Yes, so if they don't spend it, that will revert.
When do they have to spend it by? That kind of feels like
21, 22.
it was 20, it was approved. May
Theoretically, they actually should have lost it last year at the end of 2023.
Didn't they do the wayfinding signage? Those are the parking signs downtown that Tom worked on with Sarah.
So we did do some signage.
Okay.
I know that there's another. Hold on a second. You know that there's another thing in here. The park's entrance signs. Those I know were done. I can check on the wayfinding signage. I'm not positive.
Yeah, I mean, those are the ones.
Actually, I think you're right. I think that actually was recent, and those expenditures probably will be paid out this year.
Yeah, because they're up. They're those
Yeah.
navy blue signs.
Okay, well, we can get that cleaned up at the next quarterly.
Yeah.
Can I ask a question, Lisa?
Yes.
Okay, so I missed the capital because we didn't see it up at the screen, but the same questions I have with this item, you say things revert back in 3 years, but if we're going into the budget cycle, we're going to be looking at 24, 25 capital items. There were things that we approved like last year, right? And the year before that may or may not have started. Will the updates be in the notes? Just like the example I would use is we know the pickleball courts we funded at least 2 years ago. This is a CIP item. It was $350,000. And because of the FEMA maps, they weren't started.
Mm-hmm.
So that's just sitting out there. And this is something Mark I've raised too, and he knows it's like it would be good to get some messaging out there for those kind of projects that people have heard about. But are there notes? Is it up to me to go through this and see the project dates that started and kind of find the ones that we've approved in the past that haven't started and ask questions on those?
So the ones for CNR are the ones that revert back. The CIP, there is no policy to revert back. So you'll see that there's stuff here from fiscal year, 14 that still needs a state audit because the state is 7 years behind. So those carry forward year over year. Those are the bigger projects that typically have, that could have issues associated with them, which would take longer. As far as working through updates, so I report on the funding of them and where they're at.
Yeah.
I do not manage the project, so that's probably something that Mark and I could probably collaborate on if you're looking for kind of project updates and where things are and moving along and things of that nature.
Yeah, and I know it's really difficult now because we're looking forward, but it is good to know to see projects that haven't started that we funded, or that are sitting waiting before we're going to fund the next project. But I'll talk to Mark more about that.
One thing Amy does very well, as you'll see in the CIP, it has the inception date and the expected completion date. So we do have an idea of when we think, and that's relatively new. That's within the last year that we started doing that to help us for planning purposes, just to your point, because we have a ton of projects that are backlogged and can't get to the ones in the year. Why are we funding them this year is a great question.
I have to say, I did notice that and I really like that. So thank you, because it does make it easier and tells you at least that somebody's looking at it and it's going to start at some point. So it's good.
Thank you. Any other questions from board members? One thing for new members, the first selectman is an ex officio member of every elected and appointed board, has equal right to participate and ask questions. Members of the public may not be aware of that, so I just wanted to share that. And as a courtesy, we generally do let invite.
I was very quiet through all the first part of the meeting, so.
Right. Any other questions on either capital or CNR?
Yeah, just on the CNR, is the life safety analysis for the PAC, is that different from the analysis that the Board of Selectmen approved last year? Because it says it has an inception
I think I
date.
know what you're talking about. No, it's the same thing. It's when they went back and discussed it again. They had gone out to bid. Was it this year? I don't know, I'm losing track of time, but they had gone out to bid recently and the cost had increased substantially.
Right.
So that's been on there a while, but only recently have they gone out to bid and got a real number and then they increased the appropriation. So yes, it is the same project that I think you're referring to.
Thank you.
Should we update that number then? Because it's still showing 15.
Then I should update that. Oversight. Anything else on CNR?
No? Okay, moving on. Oh, do you want to do the Board of Ed and then we'll talk about doing an assignment?
Sure. So for the Board of Education, one of the things that I wanted to highlight is our excess cost grant. You'll see in page 135 of the report that we typically get our award in January. So this is something that we're very anxious to get. It's something that we are waiting on because of how it's been funded previously. So we put in our reporting for the deadline of December 1st. And now we're waiting to hear back to the state what our award is going to be. It's typically in January, but there's been business managers going back and forth and they're like, have you received your award? Have you received your award? And nobody's received their awards yet. So one of the reasons that we're keeping an eye on this is something that legislation has kept promising that they're going to increase our funding. I think we're supposed to be around 80%. We're never around 80%. It's typically a little over 70%. And then our last funding was slightly under 70% in like the high 60s. So that's something that we're very anxious to get to see how it impacts our budget for this year and potentially for next year.
Amy, can you talk about how the Board of Ed budgets that? They don't budget the gross spending on special education, they do the net.
Yeah, so this is one of kind of the quirks of the Board of Education budget, and it's the only place that we do it is related to special education is our net. So our gross budget is typically probably around like, $4 million, say. And then we're going to get back from the state about $2 million. So we just budget that net $2 million instead of showing the gross $4 million and then showing the offset and grant funding, the $2 million.
Why do we do it that way?
We've always done it that way. I don't know if there's a technical reason, or I know like Board of Eds can't take in revenue, so maybe that's their way around that and the money going directly to the Board of Education. I know in a couple of the other communities, they do it the same way. Other communities do it in a separate fund. So I'm not sure on the history of Simsbury and where that started, but it's a typical practice.
One thing we started last year is the Board of Ed now shows the gross expenditure, even though they budget the net. So members of the public can see the total cost. That's helpful to understand that, especially when the excess cost comes in less than anticipated. Okay, so one of the things this board should consider doing is doing an assignment in the general fund when we have a material overage in a department. It's a nice signal. It's a way to signal to both the public and to Mark and to everyone that there is going to be a need from the general fund to support one of the department overages. We're looking at tremendous savings with Mark, but we don't know if those savings will be there at the year end. So an assignment is an intent to spend. It could be released. It does not require the recommendation of the Board of Selectmen, but it segregates that money and says, don't use that for the budget until we're sure we know what's going to happen at year end. I wanted to get folks' thoughts on doing that. Whether people are comfortable doing with that. It's a very conservative measure, so I'm typically in favor of being very conservative. But there is tremendous amount of savings and new revenue, so it's less as important as in some prior years.
Sorry to ask, but could you just run through again exactly what assignment you're proposing?
We assigned $700,000 in the general fund. Amy actually has that as a potential motion. What page was that on, Amy? Your motion? It would be assign general fund reserves in the amount of $700,000 in anticipation of the Board of Education proposed deficit related to special education costs. I think when we do year-end transfers, I think our auditor in the past has said, go ahead and do the assignment at year-end and then do the transfer because they want to see that you've signaled a knowledge of it. The Board of Ed is different than other town departments, although it's technically a department, it's segregation. And so it's a different sort of entity than a normal town department. So to me, I'm more comfortable doing that. But Amy, do you have thoughts on that one way or the other?
I honestly don't have a preference. It's whatever you all want to do, whether we do it now and earmark it or we do it at year end. I think the important part to the auditors is the transparency and that the board's made aware of it. So whatever you guys are comfortable with.
Can you remind us of the balances in the general fund right now?
A whole bunch. Whole ton. I just have that
Remember,
number.
we keep 15.5 in just general fund reserves. That's our policy. We are anticipating coming in at 19, but that will likely go down once Mark finishes his internal transfers.
It'll be about 23 million, Todd.
Okay.
So we have the ability to do that. If there's, I'll call for the motion. If it doesn't pass, I won't get mad at anyone. Can I have a motion effective January 13, 2024 to assign general fund reserves in the amount of $700,000 in anticipation of the Board of Education proposed deficit related to special education costs?
Well, that was February 13th, right?
Yes.
Yeah, I'll make that motion.
Thank you. Is there a second?
I'll second the motion and let's move on to discussion. I mean, we had around this time last year, there was, we projected a $700,000 deficit from the Board of Education, but the board was able to lower that, I believe, by the time the year ended. So what will happen if the boards of education succeeds in reducing that deficit? What happens to this assignment?
We release the assignment, and it is with the expectation that they will use every means possible to get that to not exist at all. That is exactly right. I think, and they're aware of that. They're working hard to do internal savings to get that down.
So all the board members and staff who are listening will understand that we're not inviting them to spend that $700,000.
Absolutely not. If you'll recall, last year we did that. We gave a preliminary motion to approve the use of the non-lapsing fund in anticipation of the overage, and they did not at the end of the year need to do that. If you're concerned about the spending, we did this, like I said, I'm not going to get mad if this motion doesn't pass. I think Amy's right. The most important thing is for us to be aware of the situation. There is a law, however, that they cannot overspend their budgets without coming for a supplemental appropriation. So they can't overfund it and then come back to us later and say, oops, we were over budget. We are aware of it. And so technically they do need to come to us before they overexpend. We have in the past at times said, okay, because we're aware of it, we'll just do it at year end. But the law does require, as you know, no expenditure without an appropriation. We're aware of that. We're obviously going to make them whole. So it's sort of a technical. All right.
Yeah, so that one's important. I was going to ask a similar line of question. I guess the other line is, does this have any impact on how we think about other budgeting for the year? Or is it more of a formality that it shows that we're aware? And given the level of funding that we have, I get it, like it could be a good thing to do, but does it have any other impact for us to think about?
That money would not be available to be used in the 2025 budget because we've assigned it unless we release the assignment. Now, is that a hardship? Probably not this year because we're seeing tremendous revenue overages and Board of Selectmen.
Right. So it feels like it would not have an impact because of that.
Correct.
Right. Okay. I mean, it seems like it's good practice. Given to your point, I think it's conservative. I could see situations where you might not want to do it, but it feels like we can do it. So those are the only questions I have.
All right. We have a motion. We have a second. All in favor, please say aye.
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 The motion carries unanimously. All right. Okay, are there any other questions on either the town or Board of Ed quarterly at this point? We'll move on then to the budget discussion. Amy, can you pull up our modeling, our latest model with the new grand list numbers in it?
Yeah. Do you want the scenario one that you and I worked on, or do you want just like the flat, like fixed cost with the updated grand list?
Let's do fixed costs with the updated grand list, and then you can plug in the numbers from the workshop, Board of Ed workshop.
Okay, so this is the model. It shows the fixed costs that were presented, and then it shows the updated grand list growth at the 0.06%. I have these highlighted, Lisa, and I had worked through a scenario of keeping some debt service flat and getting rid of the cash for capital. So I just had those highlighted. It's just a reminder. So then that leaves you with a mill rate of about 32.57, an increase of 1.75 mils, and then for a $350,000 home value and a tax impact of about 5.68%.
And for the fixed costs, you're using what percentage for the town?
2.13.
And for the Board of Ed,
3.24.
At their budget workshop, it's going to come down, but that was about a 6.9.
Mm-hmm.
Can you just plug in a 6.9 and see what happens?
Sure.
Whatever that is.
And that brings us to a mill rate of 33.46 or a tax increase of 8.57%.
You got the Board of Selectmen at a 213. Can you bring that to a 3?
Sure. $33.54 mils or 8.83% tax increase.
Now, assuming the Board of Ed, they're going to come down, and they generally come down about 2 million or 2% rather. So I don't know, try 4.9 or 5%.
Oops, wrong direction. Trying to get them some more money.
They're working hard to get that down. We're still at a 7.24.
So then 33.05 mils or 7.24% increase.
Okay. Same.
Can I just slow you guys down, because I've been through this process now for a couple of years, and I've seen you go through these numbers. And Lisa, you've assured me that there are people watching this meeting, which may or may not be true. But if they really are, I think they should understand what you're doing here is playing with the fixed costs, the amounts that the two boards of selectmen and education have represented to us are expenditures that we are legally obligated to fund. And we know that those estimates might change based on how the budgets turn out. But when you talked about 6.9% from the Board of Education, that's a number that came out of their budget workshop from a couple of weeks ago. And what we're doing is suggesting that these numbers are going to produce a tax increase on the average home of anywhere from 5.8% to 7.2%, any one of which would be significantly higher even than the large tax increase that we had last year. So unless I've got that wrong, that's how I want to frame this discussion.
Yeah, I think it's too soon to tell because we haven't seen Mark's budget or the Board of Ed, and they're working really hard. I think they heard, I hope they heard. I think we all would like to get to the Social Security COLA. Is it going to be realistic this year? I don't know. But Amy, let's make it better, at least some of the out years. One of the things we had on the capital improvement plan, and Mark, I'm sure you're going to be redoing it, but the prior town manager had a plan to tax for some capital in the out years, and you'll see that in the cash for capital. We have, to Art Wallace's point, I can just say Art because Art House isn't here. We do have sufficient reserves, and those will be available in the out years if we're cautious and judicious about how we use them. So if you zero those out in the out years, and go back down, you start to see in the out years, we start to make progress in getting our mill rate a little bit better than where we were in the current year, just by doing that. And the other option we have that I asked Amy to sort of look at is our debt. We have, even before 2023, we were down in the 5 or 6 million in debt. We jumped to 7.8, then 8.9, then $10 million of debt. And I asked Amy to say, well, what if we just held debt flat at 9 million? So it's 9 million this year, and let's go 9 million down the line. Then we start to get our tax increases and the mill rates start to go lower each time you eliminate some debt. And you could go down 8.5 million as well and get the mill rate lower over time. What we had hoped to do with Amy, which did not play out as well as we were hoping, is to use some of the cash reserves to pay off some of the Latimer bonding. But even if we used the 4 million, so 4 times 9 would be 360. That doesn't really move the mill rate. Does that move the mill rate at all if we did that, Amy?
I mean, everything helps, but if let's redo.
And what were we doing there again, Lisa? I'm sorry.
We're using some of our capital reserves instead of borrowing for Latimer.
Okay, I got you. This is the 90,000 or whatever.
Yeah, that saves us like the car payment. It gets our car payment down.
Yeah. It's
So
gonna
that
be small, I would imagine, but yeah.
So that does get us down from the 7s and there. Amy, what assumption are you using on the Board of Ed there? 4 and 9 or
9. Which
one?
4, 9.
Yeah, so it's going to be a tough year. Mark, is it too soon? Are you giving thoughts on this that you want to preview, or you want to wait till March?
I've got to wait a little bit, unfortunately, Lisa, because we're really behind the 8 ball and working hard. But not that I want to keep everybody in suspense, but we're going to need a little more time.
Okay. So what we're seeing, though, is a bit of a challenge. You know, as you recall, during the tri-board, our guidance was very, very tight. It was 1.75% for each of the boards, which we knew was going to be almost impossible to meet. Some of this, however, Amy, I don't know if you can jump over to the municipal cap calculation and look at some of the exclusions there and explain that and what that looks like, because some of these costs are excluded costs. Municipal cap was passed in 2018 by the state General Assembly, and it said you can't increase your budgets, municipal budgets, by more than 2.5% of the rate of inflation, assuming the rate of inflation is 3.4. But there are some exclusions that don't count towards that cap. And those exclusions include debt service, which we know is going up by $1 million, and special education costs, also minor capital over $100,000, and pension contributions don't count towards that. So when you do the exclusions, Amy, do we meet the cap requirements at I guess we had used a 3.2. Do we meet?
This has it at 4.8. Let me just make sure. 4. That's right. That's not right. That we can add. Easy. That's fine. That's fine. So I guess it's pretty close, but we're just shy of the 3.2.
So that's, I think, when it gets to decision time for our board, we're going to be looking at 1, the guidance we gave, 2, the municipal cap, 3, the exclusions and the comfort level in using those. To Bert's point, past history, we had one of the largest tax increases in the town's history last year. I think all 3 boards don't want to do that again this year. But how we get to those numbers is going to be a challenge. I want to open it up to discussion. Art, you look like you were about to say something.
Yeah, I got a lot of questions. What's the number I should be thinking about last year? Because we had the reassessment and everything, and I think 5.18 is burned in my head, but is that right? Is that
That was the median. We had about 10% who did not see a tax increase. We had about 20% who saw a tax increase of 12% or higher. So it was all across the board. But the median tax increase was 5.18, which was consistent with what we saw with other towns going through revaluation. I think Glastonbury came in at 4.9. Farmington had a very large tax increase. Were they 9 something, Amy? Because of the reval?
just so I'm clear, because I'm looking for the net number, right? Because the vals went up, but then our mill rate probably dropped. But
Yes.
the net impact is 518.
Yes, the mill rate dropped, but people's individual taxes, what it means for me, went up for the
Yeah.
median taxpayer.
Yeah, no, that's what that's the right number, I think. Because I'm just trying to figure out, like, if we ended up at 6 or 7, whatever the number is, that would be on top of a median of 5 last year.
That's right. That's right.
Is there? Yeah, go ahead.
No, I think that's right. I just encourage members to look at the out years too. So we have to solve for this year, but we also need to start thinking about what are we going to do in future years. Obviously, the main thing that's driving this is the grand list. Grand list often comes in at the last minute, saves us. Unfortunately, it did not this year. Sometimes the governor's budget will save us a little bit. It did not this year.
But it seems like it's just that, right? Like, when the grand list grows, it's kind of saving you, because all else being equal, if inflation is right, you should be having people increase the same amount as the inflation would be increasing actual expenses, right? So grand list growing is obviously great. And if we can grow revenues, it's awesome. But the reality is, if it's not growing, I don't know that that's not still a good reason. There's still not a great reason why we wouldn't try to keep people close to CPI if we could.
Absolutely. One of the long-term projections Amy used, and I think it's right based on past history, is we look at municipal growth both on the town side and the Board of Ed at about 3%, so generally higher than the average inflationary rate in normal times. But the reason why that has worked in the past is we've seen progressive grand list growth. Our grand list, I guess, median or average over the last 20 years is about 1.1%. So we're quite a bit below it right now, coming off the reval. So that's part of but you can see the
grand list is only going to grow for so long, right? At some point you run out of growth, right? Unless we take over Avon.
Those sound like fighting words, yeah.
I meant that facetiously.
I know.
Is there any smoothing we can do year to year? Like, it's a little weird, and I realize we just sort of threw some numbers in for the out years, but if we did feel reasonably good about having accountability to have those numbers as low as they show up in the out years, it's weird to say, well, we're going to increase you by 4 or 5% this year, and then next year is only going to be 1, and then it's going to do this. Like, is there a way to smooth that to say, I'm going to cap it without overdoing sort of the use of reserves or otherwise to sort of keep it smooth? Is there a way for us to think about that going into this, or is it completely pay as you go?
It's pay as you go, but we can use some reserves to smooth. When we lost the Hartford, which was our largest taxpayer, we smoothed in the loss of that revenue over, I think, 2 or 3 years to just make it easier on the taxpayers. So there is that possibility to evaluate. Amy, do you want to speak to that? It's mill rate stabilization. Can you talk about how that might work, or is that something you think this board or the policy board should consider?
Yeah, so if you're just going budget year to budget year, it's kind of hard to, not do a pay-as-you-go situation. But if we could do some long-term planning, there is some opportunity there to try to get on that even playing field so that we don't have those spikes. There was something else I was going to say related to that. Hold on, I just lost my train of thought.
Well, Amy, while you're thinking about that, I guess, it just seems to me that on the heels of a reassessment, and there's a lot going on there, and I'm assuming that taxpayers probably expected some movement there, but to have then on the back end of that another year of it, I don't know, it just seems like we should have some consideration of something to smooth.
Right. So actually, I found my point. So there's also, I chat with fellow finance directors on the GFOA. I have a couple mentors that I reach out to. There is a state statute where if you have a lot of like one-time expenditures that are coming up during the year that are going to have a huge tax impact, you actually can smooth that over 5 years. We'd have to look to see what is eligible for that. Like, is our special ed increase this year eligible for that? Technically it's probably not a one-time, but it probably won't be increasing that much year over year. Could we take the route of losing 1.5 million in motor vehicle assessment that we're using this year and smooth that over 5 years? So I have like some more work to do in researching some of these things so that there could be something that we could help mitigate this year and going into the following years. But when you're right up on the budget year, it's a little bit more difficult. If we could do some of that out year and, for example, taking Lisa's idea of we want debt service to be 9 million every year and change our approach and not use a percentage, or, start to build in that percentage differently, or, there's a lot of more options that you can think about on a long-term nature to try to smooth that over time. So I guess that's my long-winded way of saying that in the budget year, there's probably a few things that you can look at, but it's really the long-term planning that's going to get you to that smooth position that you're looking at.
Amy, one thing to make the model a little better, we heard from Fiduciant. Can we change our interest investment income and add $1 million there? So change that to 13. That starts to get us back to where we need to be. So one of the things I think what I'm hearing from our board is if we could get some laser focus on what that number should be from interest investment income, because as Amy always says, what goes up eventually comes down. So we want to make sure that we budget conservatively, but to Art's point, perhaps a little aggressively there because of the spike we're seeing there. One of the reasons why we do use the tax collection assumption rate is that if we're off on the revenues, we have a fail safe. And that's why it's there. So Amy, perhaps, as we get through March, if you could really take a hard look as to what that number should be. The other thing Amy looked into, and I'm hoping somebody called her back and said, I've changed my mind, is how to use the municipal revenue sharing. Usually we don't budget until we have 3 years history. We now have 3 years history of getting it. But Amy did reach out to OPM, and why don't you share what they said there?
Yeah, so I reached out to OPM about potentially budgeting for that municipal revenue sharing, and I did not get a positive answer on moving forward with budgeting that. like essentially they're not going to provide that guidance, but the volatility of it, it's not something that's recommended. But it is something that we have gotten that we can get, and it's just how much of a risk are you willing to take?
So perhaps the risk is more predictable with the interest investment, even though that's still an uncertain number. It might be more certain than the municipal revenue. Is that sort of how you think about it?
Yeah. So me personally, just being of the conservative nature, I would rather overbank on investment income, knowing that we have the safe fall in state revenue than, because the investment income, even if it doesn't come fully to fruition, there's a chance it might come partially to fruition. Whereas if it's state revenue, it's either you get it or you don't. That would just be my take, is to play with the investment income as opposed to the state funding.
What flexibility do we have with the investments? Because, I mean, there's a lot of talk right now that the Fed could start dropping rates sometime in the middle of the year, although there was sort of questionable inflation information. I think that came out today. So not sure if that is still the case, but, there are strategies you can have if you think about like laddering CDs and things like that. Given the amount of money we have, I don't know that that's possible for us, but if it was something that we just wanted to lock in and make sure that we could take advantage of the short rate being at 5%, for the next 12 months, I think there are ways we could do it. It would probably have us being somewhat encumbered on that money for that period. We'd have to ladder things out or whatever, but is there flexibility for us to think that way? Or do we have to have it in unencumbered cash that we can just get immediately?
No, we can put money into CDs and things of that nature, the short-term investments. It's actually something that we should look deeper into. I was waiting for the Latimer Lane project to be the majority at completion. For our bonding, we actually pre-fund, and then with the bonding money, we repay ourselves. So we are tens of millions of dollars in the negative, so to speak, for that project. So we're floating that cash. Which luckily we have enough cash flow where we're able to do that. But once we have a project that's not a $30 million project, then absolutely there's more than enough reserves to try to get into those CDs and look at our investment opportunities.
Okay.
Amy, if I could just jump in and ask a question, because I don't know the answer to this, so that's why I'm going to ask. But in years where the town has had significant grand list growth, has there been a policy either of this board or elsewhere that there are specific contributions made to reserve to fund balance? I mean, at least, let me parse it this way. In New York, the equivalent of what you would call mill rate stabilization here in Connecticut has to do with allowing funds to go into fund balance based on grand list growth without going over the New York state tax cap. So I don't know, has there been any deposits to our fund balance as a result of the grand list growth that the town experienced in the past?
So that's a good question. I don't think it's ever been directly related to grand list growth. It's always something that's been evaluated via our year-end results. But no, we don't make a budgeted contribution to fund balance because our grant list has increased.
Creating, I mean, just looking ahead to the future, and it's particularly helpful during reval years, because you have this turbulence and obviously a disproportionate impact on many taxpayers as a result of revals in rising property value eras, if you will. And to Art's point, smoothing is really the answer, and whether you do that by forward planning when you've got grand list growth or some other mechanism, it seems to make sense to me. But I can share with this board that we're very concerned internally about the impact of the potential tax increase on the heels of what the town residents experienced last year. So we are laser focused. I think that was the term I heard a few moments ago, and that's an accurate description of the approach that we're taking to at least the release of the town manager's budget before it gets to board review. So and thanks for that answer, Amy.
One of the things we'll be looking at, Mark, as I'm sure you will as well, is where our mill rate is falling with our comparison towns, and so that we remain economically competitive and don't find ourselves in an economic spiral. We don't have a lot of information on there. Avon is the town manager is coming in with a 30.5 mill rate, and Glastonbury 32.45. Our current mill rate is 31.82, including the fire district. So there's not a lot of leeway just on those two. We'll see what other towns come in, but that's one thing I know we're going to be monitoring there. So it's not just, it is, of course, the impact to the individuals, especially the 20% who are ALICE qualified or below the ALICE threshold. But it's also our competitiveness with other towns and our neighboring towns, which is going to be a challenge. But that's why I think it's important. We need to take, to your point, Mark, a long-term look. We may not be able to entirely solve this year, but we need to really make an effort to make sure we're solving the out years.
Lisa, I appreciate that. And just a quick comment on this, and it goes back to, I guess, my tax collection days and working through at least one major reval in Hartford. But when you mentioned the high end of the tax increase that our residents experienced as a result of the reval last year, it's obvious that biggest increase was amongst the property owners who owned property in the highest value range. Do I have that correct? And if so, then the properties that were of lesser value experienced a lesser percentage, not just a lower dollar amount. Is that right?
No, that's not what we heard from the reval. For some, absolutely, because last reval, some of the higher homes came down in their numbers and then went up. But we heard from the reval, and Amy, I'll let you speak to that, that it was some of the middle homes that saw a tax increase. Do you want to speak to that?
I don't remember off the top of my head. The higher valued homes did have a larger tax impact. But what you would typically, we were anticipating the higher value homes would take the brunt of it, and then the lower value homes would see a decrease or leveling off, so to speak. But we actually didn't. So we revaled at the height of the market, so everything went up. The high end went up even higher, and the middle class went up high. So there really wasn't any tax relief in any set group of homes during the last reval, unfortunately.
Mark, one of the things that happened in our town, as happened in Glastonbury and Farmington, is there was a shift. A lot of our commercial values went down, so some of that shift got imposed on the residential. Yeah, Farmington was a dramatic example of that. That's why they saw the 8 or 9% tax increase median, because that shift, they had more commercial property than we do.
So when you look at the mill rate of our peer towns, I guess alongside that information, we should look at when each of those last had their reval, right?
Absolutely. Amy, I don't know if you can put up my PowerPoint. You don't have to do it now, but just on the budget page there, but it shows the mill rates and when the reval years are of the comparison towns, so that we can watch those. Like Avon last year had a 35.39 mill rate. This year, a 30.5. Dramatic decrease, but it's a reval year for them.
So, Mark, your amazing budget team has your staff working on that right now. So coming soon.
It goes without saying, Amy, and I'll just take a quick opportunity to thank you, Melissa, the entire team. I know it's been a grueling 3 weeks or longer. So keep up the good work, and we'll get where we need to be with the help of our boards and all our colleagues.
Very good. Amy, one of the things I did have a question someone asked me, can we post the budget dates on also on the town fiscal year 2025 budget page?
Sure.
Thank you. I'll open it up. Todd or Bert, do you have any additional thoughts on this?
No, not for this moment. No.
No, I mean, these are all things we've talked about the last couple of times we've gotten together and just repeating it. I do like the idea of like looking out. I'm not sure how the model works, so I don't know if like the growth of the 1.13 next year was just kind of disrupted because we changed the numbers. So it might be smoother than we think. But I think that will just help the guidance to the other boards going forward. We'll already kind of know, give or take, where we want to be. But we just have to wait and see what kind of numbers we get back.
Right. How do people feel about starting to think about debt instead of a percent? Obviously, if your budgets are going up 6 and 7%, debt service, you can't do it off the percentage of the operating budget. Instead, switching our guidance towards an actual number, like leveling off at the 9 million or 8.5 million.
But doesn't that kind of, 4 years out, 5 years out, the percentages are going to just be off? I'm not sure.
Well, not entirely, because depending on how you look at it depends on budget growth. But one of the things we can look at is the depreciation of assets, and our depreciation of assets in the last, which is why I'm looking forward to seeing what the comprehensive annual financial report shows, was about $6 million. So if we're investing 9 million, we are well within the range of what's appropriate to invest that on top of the capital reserves. So that does give us a capacity to lower. Do we want to think about reducing our debt? And to me, I think that's something we need to start thinking about, especially if we're at a high interest world at this point. I think that's something we should think about.
Yeah, and then the flat dollar amount, again, helps the planning going forward. And if the percentages are falling too low, maybe there's a little bit of leeway for something extra to get in there.
Yeah, I mean, one thing we can do is if we get debt, if you think about the debt service as the CARB payment and keep it at 9 million every year, and you can still lower debt and keep the CARB payment at 9 million by creating cash capacity. And then as you get the debt lower and lower, you keep that 9 million flat. All of a sudden, when you're ready to do a senior center or Latimer, you now have capacity to borrow. That's one way to think about it. Right. So are we ready to move? Did you want to give some thought? Mark, you look like you were about to say something.
No, I thought you had asked Lisa to put up the budget calendar or something, or did I just imagine?
Yes. No. Just post it so that people know what the dates are.
Oh, okay,
I
good.
had
Yeah.
one ask when the hearing was. And just for members of the public, it was scheduled for April 2nd, but there's now a presidential primary on that date. So it got moved to Wednesday, which is unusual for our board. It will be Wednesday the 3rd.
Thank you. That's it.
Okay. Amy, did you have other thoughts that you think our board should be thinking about in the next couple of months or weeks, rather?
No, not yet. Like Mark said, we're kind of still fleshing out his side of the budget, and so I don't even have a clear overall picture yet. So more to come.
Right. As I guess I would reach out to both Wendy, Mark, and Amy if you get any more insight as to which inflationary number OPM is going to use for the municipal cap. Is it going to be 3.1, 3.4, 3.2? It's not clear to me which one they use. It looked like from the governor's report, he's projecting the 3.1. So once we know that, that would be helpful. And then 2 is, particularly for Wendy and Mark, is the other Farmington Valley towns come in with budget updates. If you could let us know where the other towns are landing in terms of their budgets as recommended by a town manager or first selectman, and then by the boards, so that we can.
Will. Yep.
All right. So we are now moving on to the proposed Board of Finance agenda items. These are not something we need to vote on. These are things that we put on that we have done in the past. And they're placeholders to help us plan so that we don't have a huge crush of discussion in one night. Although the comprehensive annual financial report will be ready for March, we are not going to have time to do that presentation in the middle of the budget. So we'll push that off till April unless someone feels strongly about it. Amy has told us that she doesn't expect any major changes from the year-end close, so we don't expect the numbers to change. And there's nothing of material that we should be aware of. Is that still the case, Amy, before we go into budget?
Yep, that's accurate.
So as you go through that, take a look. If there's something you want, we can always add it as needed by members of the board. All you have to do is ask. If you could give it, 2 weeks in advance, that's helpful to Amy for planning purposes, but we'll try and accommodate that. And types of things you could ask is to invite the actuary back in, the health advisor we've had in the past, type stuff like that. So give that some thought. And if you see something, another good thing to do is look up what other towns Board of Finances do, which is pretty much what this was built off. All right. So if there's no questions on that, we'll move on to the draft annual report, which is found on page 140 of your packets. Interestingly, our charter assigns this to Mark. The town manager's duties include assisting the Board of Finance in the preparation of the annual town report, and Title VII, Chapter 112 of Municipal Finance, Section 7406, requires the Board of Finance to do an annual report, although the details of what needs to be in it is a little fuzzy. It is different than the comprehensive annual report that we will be getting later in the month. But basically what it is, it's almost a citizen's description of the state of the finances of the town. So it's a little bit more readable and approachable is what it's meant to be. But it is to contain such matters the Board of Finance deems advisable. So I don't know if you want to walk us through the draft report, Amy or Mark?
I don't really have anything other than just noting that the boards are listed as requested from the last time you all reviewed and had suggestions and updates. And I think the rest is just status quo from year to year.
Ask for feedback from Art and Bert and Todd.
I mean, is it similar to what it's looked like every other year, right?
In past years, there was more detail. There was a little more, one of the things is other towns do fiscal indicators. There's a little more graphs, a little more detail. There are tables of contents. I mean, this is the kind of thing we could spend hours on. Me too. So I don't know where people's interest. I mean, I think there's an opportunity to be more communicative with this document with the public, but is it worth the amount of time and effort it would take to get us to that state? I guess I would say to board members, why don't you look at annual reports of what other towns do and see?
I'm sorry. Have we gotten feedback from anybody saying that they wanted more of this information, or is this just what
I did. But it's not some matter of feedback. It's more what do we want to communicate to the public about the town's finances? And if people are comfortable with it, then we leave it as is. I think it's worth us looking at what other towns do and deciding does this give a picture to the public? Part of our job is not just citizen oversight, but communicators of the fiscal state of the town. In the past, it's been a very low priority because it takes a lot of time and not that many people look at it. So we can continue along that line, but I just wanted to raise it.
So this is a draft. What has to happen for this to be finalized?
I think we would have to approve it.
Yeah, you all would either make suggestions for changes, and if you have none, then it would just move forward and be published.
I would just jump in and add that, obviously as the new town manager, I didn't have an opportunity to dive into this to the extent that I would be inclined to. So, I think what I'm hearing, and certainly Lisa and I think the same way along the same lines, that, any opportunity to convey good and accurate information to the public, maybe in more of a lay person's terminology than we might discuss at these meetings, makes sense. But, so you could probably expect to see this growing in scope during my tenure here at the town, but just my thoughts, just for the discussion's purposes.
Thank you. We appreciate that. We understand all of you have a lot on your plates, so this is something that can take 5 years to get where we want, if that's where we want to go. But it's worth thinking about how we convey to the public just the state of our town, because our budgets are our values, and we can reflect that. One thing going forward, I think it might be helpful to have a table of contents, and I do want to appreciate and recognize Amy. Thank you for adding the board members in that. It would be great if we could add in the future appointed board members as well, because we have people who are giving hundreds of hours of their time for free because they love our community, and this is an easy way to recognize and thank them. So that's the only thing I have there. So I would just say, as Mark takes a look at it just this next year, when you have a free moment, go and look at what other towns do and see what strikes you as helpful, that you think the residents might find helpful. But no action today. If people are comfortable with it, we can go ahead and approve it. Or do you want?
Can I just? I'm sorry. Can I just ask a question? So, Mark is charged with putting it together, but we approve it. I'm confused about that.
So the charter says the town manager's duties include to assist the Board of Finance in the preparation of the annual report. Our charge to prepare the annual report comes to us from the state statutes, Title VII, Chapter 112, Municipal Finance, Section 706, Town Reports. If you actually read the language, it's terrible. It's very unclear as to what it needs to include. It needs a statement of reports of town officers and boards as required by law, but it doesn't tell you which law requires which boards to report. A statement of the amount received by the town under 11A of Chapter 240, which is town aid funds for highways and bridges, but that might have been repealed. It's not clear whether that's still in force or not. An itemized account of the disposition of such an amount and such other matters as the Board of Finance deems advisable. That is literally what it says. So it is very difficult to know. So you look at what others do. It in some ways, it's not meant to replace the annual comprehensive financial report, which is the detailed heavy book that we're going to get in a couple months. It's really meant to be a citizen snapshot of the state of the town, showing what we spend, why we spend, what we measure, and what do you spend and what do you get, and how much.
Yeah, I was just asking about the process. I mean,
yeah. So technically, it is our charge. But because we are volunteers, we don't have staff to do that. The charter puts that on Mark, technically, but I think it generally falls to Amy and some of the people that she delegates it to. I don't know who does that. Who did the work on this, Amy?
Actually, the town manager's office does it. His staff does it. Mm-hmm.
So the town manager's staff does it. So it's a matter of, some of this stuff is easy to accommodate. Mark's really good at that. You have it, the stats in the annual report that we're going to get in February. So it's just, how do you translate complicated financials in a way to the public to help them understand where their money's going?
No, I get it. I was just asking about the process. We approve it. That was really all I was. And then once we approve it, then it's ready for publication.
So technically it's supposed to be published, but I think we just post it. I think they might have changed the law on that. It's a little bit of a mess. I'm not going to lie. Is that fair to say, Mark?
It is. And, this is where did the various statutes and policies all come together, and what does it look like? I think realistically, the burden is the duty falls to me to do the work and get it done, and then it comes to you for approval. So I guess that's another opportunity for this board to question, or ask for further clarity before the report is published. But I think that what we'll see moving forward is a more comprehensive report that, just looking ahead to how I might want to present it is, I think, to Lisa's point, in a way that is maybe less financial and a little more narrative in terms of how town projects come together, how the mill rate is, all of the things that we would want to make sure that the public understands, and kind of weave a story that makes sense, because you've got your CAFR that has all the detail and your budgets and all of that stuff, but what's that translation point that I had the opportunity in Poughkeepsie to write, 5 states of the city and 7 budget messages. And the narrative pieces are quite interesting to me, because I think that's where local governments particularly fall a little short in making that narrative case to their taxpayers and to their residents that kind of brings everything together. So I enjoy doing these types of pieces of work, and I think you could look forward to seeing a little more detail and that story moving forward.
Thank you. We'll look forward to working with you, and as members have things they'd like to convey to the public, we'll certainly share that with you. And I think that will be a good partnership, and I appreciate your initiative there, and looking forward to working with you on it. Okay. So technically, we're not supposed to pass this until we've received the annual financial comprehensive report. It's dependent on that numbers, and it's due 30 days after that. So do we want to wait, Amy, or just do it contingent with the numbers that might change after the report's finalized?
So based on the auditor feedback, there are no changes. So I think you're safe to approve it if you want to. If you prefer to err on the side of caution, that's fine too.
I'm
I think we're
comfortable.
at a point in the process where it's okay.
We can amend it if there's anything material that needs to be changed. Okay, with that,
I'll move to approve subject to those conditions.
okay. Is there a second?
Second.
Any further discussion? All in favor, please say aye.
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 The motion carries unanimously. And then we'll go on to the Junior Women's Club. This, as you recall, when we did our rules of procedure, we passed a provision to do a consent agenda. And going forward, this is the type of thing I would put on a consent agenda. It doesn't really need discussion. There's no spending without an appropriation, because this is a new grant. It would be technically a supplemental appropriation. So we need to approve it, but it's a pro forma because there's no impact to the operating budget and no match. So when we get grants that are in that way, no match and no impact to the operating budget, would this board be comfortable moving those to a consent agenda without requiring discussion?
Yes.
So in the future, we'll go with a consent agenda on that. But since we haven't done that this time, Amy, why don't you tell us what this is, and then we'll move on.
Yep. So this is a $500 grant that was applied for via the Simsbury Women's Club grant program. Kristen would like to utilize those dollars to offset the cost of the Veterans Picnic. So if awarded, we will have $500 to do so.
Okay. Any questions for Amy? All right, with that, may I have a motion effective January 13th, 2024 to approve a supplemental appropriation for the Simsbury Junior Women's Club's grant in the amount of $500 if awarded?
So moved.
Okay.
Second.
Any further discussion? Sorry about that, Art.
No problem.
All in favor, please say aye.
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 And that motion carries unanimously. Then we have the minutes from December 19th. The members have an opportunity to review the minutes. Okay. May I have a motion to approve the minutes of December 19th, 2023?
So moved.
Second.
Any further discussion? All in favor, please say aye.
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 Motion carries unanimously. Amy, when we get the draft minutes from our clerk, can we get those up as we receive them before the meeting on the town website? Thank you. Okay. All right. And now we will move. I'm sorry that our house cannot be here for the cyber security update. We do get those updates in executive session. Okay.
Do we need a motion to go into executive session?
We do.
Then I so move.
Can you do it pursuant to Connecticut General Statutes 1-206C and 1-206E cybersecurity update?
That is exactly how I move.
That's what I heard.
Is there a second?
Second.
Any further discussion? All in favor, please say aye.
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 We are now going into executive session and we'll stop filming and broadcasting live.